a firm with global strength, or a specialist boutique? What if you didn't have to choose? With Franklin Templeton, you don't. Instead of this or that, we aim to give you this and that, global strength and boutique specialization. It's the best of both worlds. Managing client assets of around $1.5 trillion, we're one of the world's largest asset managers, and we have close to 1,300 investment professionals located across 20 countries, which gives our millions of clients around the globe an ear to the ground in the world's most critical markets. But just as important as our size is our unmatched collection of independent specialist investment managers, including their global network of accomplished ESG experts all under one umbrella, and backed by Franklin Templeton's global infrastructure and financial strength. This gives our independent investment managers access to large-scale capabilities in research, data analytics, and servicing, and lets them share in our values-based culture that fosters diversity and inclusion as a key ingredient in the success of our business. And that gives you boutique custom specialization across a comprehensive range of asset classes and geographies, as well as investment styles, approaches, and vehicle types to best meet your needs. This powerful combination of global strength and boutique specialization fulfills our single focus on delivering better client outcomes. It's the best of both worlds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Life is full of choices. Coffee or tea? Gas or electric? Book or movie? Large or small, decisions are usually a matter of this or that, one or the other. Until now, that's also been true for the critical decision of which investment management firm to work with. A firm with global strength or a specialist boutique? What if you didn't have to choose? With Franklin Templeton, you don't. Instead of this or that, we aim to give you this and that, global strength and boutique specialization. It's the best of both worlds. Managing client assets of around $1.5 trillion, we're one of the world's largest asset managers, and we have close to 1,300 investment professionals located across 20 countries, which gives our millions of clients around the globe an ear to the ground in the world's most critical markets. But just as important as our size is our unmatched collection of independent specialist investment managers, including their global network of accomplished ESG experts all under one umbrella, and backed by Franklin Templeton's global infrastructure and financial strength. This gives our independent investment managers access to large-scale capabilities in research, data analytics, and servicing, and lets them share in our values-based culture that fosters diversity and inclusion as a key ingredient in the success of our business. And that gives you boutique custom specialization across a comprehensive range of asset classes and geographies, as well as investment styles, approaches, and vehicle types to best meet your unique needs. This powerful combination of global strength and boutique specialization fulfills our single focus on delivering better client outcomes. It's the best of both worlds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Life is full of choices. Coffee or tea? Gas or electric? Book or movie? Large or small, decisions are usually a matter of this or that, one or the other. Until now, that's also been true for the critical decision of which investment management firm to work with. A firm with global strength or a specialist boutique? What if you didn't have to choose? With Franklin Templeton, you don't. Instead of this or that, we aim to give you this and that, global strength and boutique specialization. It's the best of both worlds. Managing client assets of around $1.5 trillion. We're one of the world's largest asset managers, and we have close to 1,300 investment professionals located across 20 countries, which gives our millions of clients around the globe an ear to the ground in the world's most critical markets. But just as important as our size is our unmatched collection of independent specialist investment managers, including their global network of accomplished ESG experts, all under one umbrella, and backed by Franklin Templeton's global infrastructure and financial strength. This gives our independent investment managers access to large-scale capabilities in research, data analytics, and servicing, and lets them share in our values-based culture that fosters diversity and inclusion as a key ingredient in the success of our business. And that gives you boutique custom specialization across a comprehensive range of asset classes and geographies, as well as investment styles, approaches, and vehicle types to best meet your unique needs. This powerful combination of global strength and boutique specialization fulfills our single focus on delivering better client outcomes. It's the best of both worlds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Life is full of choices. Coffee or tea? Gas or electric? Book or movie? Large or small, decisions are usually a matter of this or that, one or the other. Until now, that's also been true for the critical decision of which investment management firm to work with. A firm with global strength or a specialist boutique. What if you didn't have to choose? With Franklin Templeton, you don't. Instead of this or that, we aim to give you this and that, global strength and boutique specialization. It's the best of both worlds. Managing client assets of around $1.5 trillion. We're one of the world's largest asset managers, and we have close to 1,500 investment professionals located across 20 countries, which gives our millions of clients around the globe an ear to the ground in the world's most critical markets. But just as important as our size is our unmatched collection of independent specialist investment managers, including their global network of accomplished ESG experts, all under one umbrella, and backed by Franklin Templeton's global infrastructure financial strength. This gives our independent investment managers access to large-scale capabilities in research, data analytics, and lets them share in our key ingredient in the success of our business. And that gives you boutique custom specialization across a comprehensive range of asset classes and geographies, as well as investment styles, approaches, and vehicle types to best meet your unique needs. This powerful combination of global strength and boutique specialization fulfills our single focus on delivering better client outcomes. It's the best of both worlds.
Mutual fund investments are subject to market risks.
Welcome back, everybody. So now, as I mentioned, we move on to the next bit of the session with a panel discussion on strategic insights and innovative opportunities to deploy capital for family offices. Please join me in welcoming our moderator, Mr. Puneet Jain, who's the Assistant Vice President, Asset Management, Karun Carpets Private Limited, from the Karun Thapar Group. He manages the portfolio advisory, Global Markets Watch, fund management, research, market updates. Joining him on the panel is Mr. Ms. Benafer Malander, who's the Chief Investment Officer, Ray Amit Patni Family Office. She's a seasoned financial markets professional, four clients to end-to-end setting up of new businesses and following that up with a robust performance. She also has served as a director on the board of Bombay Shirt Company and an advisor to the board of Waterfield Advisors. Welcome, Benafer. Also accompanying is Mr. Rajesh Kunnath, who's the director from Corporate Advantage Government Limited. He heads the overall responsibility for the family office, responsible for all compliance, government issues covering group and associate companies or the flagship company on an ongoing basis, and the assessment of investments being made by group companies beside periodical monitoring of performances. Also joining on the panel is Mr. Sunindra Balal, who's a portfolio manager, Aces Investments Private Limited. Welcome to all of you on the panel. And with this, I look forward to a great session. Over to you, Mr. Puneet.
Yeah. Good morning, everyone. I welcome you all for a discussion wherein we'll try to pick the brains of these panelists on various opportunities that family offices can capture during these times and what are their views on the markets and the investing landscape. With me, I have well-known and extremely experienced individuals who've been involved for many years in this ecosystem. To put the context to our discussion, let me just brief you what we are looking at. 2020-21 were years of great learnings and unlearnings. We saw the fastest ever recession in 2020, greatest ever policy action, and quickest bear market recovery. And we ended the year with all-time high market levels in most of the global equity markets, amid expectations of greatest ever economic growth in 2020. Similarly, 2021 also delivered one of the most spectacular years of equity returns, and because of tremendous fiscal growth support and unlimited financial repression. These 2 years, I think, were a humbling experience for all the forecasters and analysts, and we all learned a valuable lesson: do not fight the central banks. 2022 began on a rather volatile note, with uncertainty around central banks' actions in the year going forward, grabbing everyone's mind on one hand, and potential geopolitical, economic, and asset implications of current Russia-Ukraine conflict on the other hand. Equity valuations are expected to remain elevated, and returns in next 3 to 5 years will be driven largely by earning upgrades. After a period of almost 7 years, wherein Nifty earnings have single digits, we're now in a phase of strong earning momentum, led by robust economic recovery, massive cost restructuring, and fiscal push, and also a high degree of operating leverage. Nominal GDP growth for India is expected to be in double digits, and data suggests that whenever India's GDP growth has exceeded 12%, we've delivered a return of high teens. Rise in inflation and improvement in economic activity are expected to bring volatility in bond markets and keep the yield curve steep. Large global central banks have indicated tapering and increase in interest rates, which will keep markets also on tenterhooks. We've already seen yields hardening across various markets, with USD touching US dollar 10-year gilt touching 2% at one point in time. In India, too, CPI inflation has been sticky, and however, gradual return to normalcy is expected as soon as supply disruptions fade and expectation of good agricultural crop also ease pressure on food prices. RBI has been accommodative till date and to stimulate growth, but it has also fallen behind the curve, and it should normalize now the surplus liquidity in a non-disruptive manner. Downside risks have increased in bond markets, and to navigate this volatility, proper diversification strategies will need to be followed by investors. Throughout the pandemic, the challenges related to pandemic have resulted in amplifying the need to leverage technology. There has been a significant shift towards internet and digital economy. Technology is becoming the new capex. We've seen the Indian startup ecosystem becoming the third largest in the world, with over 55,000 plus startups from early 2000s. India is still the third largest country in terms of unicorns, both in terms of number as well as value. In last year alone, there were 42 startups which emerged as unicorns, highest in history in any given year. Startups raised almost 38 billion US dollars in 2021 across almost 1,400 deals. With over 250 plus incubators and accelerators and over 500 plus institutional investors, the system is only getting stronger. The startups are demonstrating non-linear business growth, attracting capital like never before across various verticals like e-commerce, deep tech, enterprise tech, food tech, etc. The key reason which I believe for this acceleration and unprecedented pace of growth for the startups is digitization, which has transformed not only India but the globe. With almost 61% of population being internet users and 80% population using mobile phones, supported by lowest cost of data, there's a huge appetite for digital consumption in India. Data consumption has gone up 17 times in last 5 years. The other key driver to this digitization has been technological prowess and availability of abundant talent at reasonable cost. So we've over the last few investing in venture funds and directly in startups has gained significant traction. Further, various startup accelerators are providing opportunities to investors to invest into startups with smaller ticket sizes. We are at a stage where there are abundant opportunity in this space, right from early stage investing to pre-IPO stages. And as a family office investor, we need to evaluate and allocate money according to our own timeframes and risk appetite. With this backdrop, I would now like to carry forward the discussion with our panelists and see what opportunities lie ahead as of in this investing space. So my first question to everyone is, what are their views on Indian and global economy? I mean, do they think the current valuations are sustainable on equity markets? Also, we are coming out of long accommodative policies of central bank. What impact do they see of this on debt and equity markets? May I start with you, Mr. Sudhindra?
Hi, Puneet. Thank you. With respect to my view here, is that until this so-called invasion, Russia, Ukraine was there, we were thinking that there will be a long sideways movement for about 6 to 8 months until the tapering information is fully digested. Because as of now, there is an expectation of rate hikes and liquidity being driven out of the market. But we have not seen that in action. So one is thinking, the other one is action. So until the action happens, people don't settle. They always keep on rolling their expectation higher or lower. And so we knew that it was going to be a sideways, and then there were external risk because pre-invasion also oil or commodities were going up in the hope that there will be demand pickup because inflations are coming in, the growth is coming in, and so forth. But post end of February, there's a completely new phase that's bringing a lot of confusion and a lot of rethinking. We are going back to the drawing board. So instead of 6 months now, it might be 8 months, 9 months to see where exactly it's going to happen. Because this particular instance has not only got back higher imported inflation, but it's also bringing in some liquidity squeeze. In terms of liquidity, freezing up, the commodity trade is not happening, shipping lines are not happening, exports are not happening, imports are not going to happen. Anyway, we have been complaining about ship shortage and other shortages, etc. I personally feel that it is yet to unravel as to what kind of damage that this whole incident has got into place. So it's going to be a little long drawn, confusion, especially for the equity market, and we are on the debt market also, and we are not going to see a significant ramp up from here on for about 6 to 8 months.
Right. I agree. I mean, the disruptions caused by these geopolitical issue is going to affect the economic activity across the globe. I mean, I am afraid if even the central banks start thinking of parking their treasuries elsewhere, depending on their trade relations with different countries, right? I mean, the ramifications can be huge. What are your views, Benafer, on this?
Well, very challenging times ahead. That's all I can say. So over the years that I've been managing the family office here, I think what we've learned is there are cycles to every asset class, and very few times in history is when most asset classes are converging into a negative bias. So what I mean by that is, historically, if you have equity underperforming, you'll have a safe haven in debt, and then if you have debt doing a little worse, you'll have something in gold, and that kind of variance is available. But definitely, I think the next a few months are going to be very challenging to see where we can find pockets of opportunity. We can't put a finger on what happens on 15th of March, though Jerome Powell's statement yesterday came out and suggested which way it will go. But overall, liquidity that is sloshing around the system in India and offshore, somewhere that will have to be balanced back, whether now or 6 months or 9 months down the line. I think the key lies in how soon this situation finds its end result. As far as the invasion part of Russia, Ukraine is concerned. Till the bombing is on, I think there is no answer. If there are some talks which happen in the interim, maybe it will soothe the markets a bit, both on the debt and the equity side. Uh, since most people talk a lot on the equity side, and of course, we'll have to see how the Surendraji mentioned that the supply chains and what is the outcome of that, and the transfer on costs and all that will only be known in the next 2 quarters from here. So I think that's for everyone to wait and watch. But on the debt side, we are definitely up for challenging times, especially with allocations in India. I think that we are in a cycle which will be, on the reverse very shortly. I think it might get postponed a month or two here there, but I think it has to start on the upward side. And when interest rates move on the upward side, everything in the economy gets more expensive. Companies will find it difficult to kind of raise money, and forwardly cost of capital becomes more. So let's see how it pans across. But yes, it's going to be a wait and watch, and kind of rebalance kind of year without a plan for the whole year in the interim.
Right. I mean, even from the apart from the disruption that we are seeing in energy prices, particularly Russia, Ukraine being big participants, the stand from OPEC has also been still the same. I mean, everyone is supporting the higher oil prices, it seems, which I think, particularly for India, is little worrisome, right? The crude affects us directly in terms of our current account deficits and costs. So, I mean, what strategy do you think the family offices should adopt in such a scenario where the risk is increasing in both fixed income and debt space? I mean, are we should investors, the family offices, be looking at diversification in terms of global markets also, where the risk seems safer, maybe USD assets?
So USD assets also will be challenging in the coming times. I think we have had assets offshore in the past as well, and if you've tracked US markets close enough, you will also understand that they are on a downward spiral, and some of them have deeply corrected as well from their highs. So when it's a flight to safety in general context, I don't think any region is ring fenced to that extent. Best is to play what you understand the most. That is my recommendation. We tend to do very simple things when we are managing the portfolio. We don't overcomplicate. So, if you see value in the top 10 stocks in India, then you keep it there and don't really move over to another zone. You see value in gold as, if you see an opportunity for a re-entry in gold, I think there is value to be unlocked there as well. And I think we will have to try and see where to find these pockets and kind of capitalize. But as I said, they will have to be short-term calls and not calls for a 3-5 year term.
Right. So Sudhindra, how do you think the diversification can be brought to the portfolios? Gold, commodities, impact investing, ESG, Bitcoins. There are so many global opportunities which one can think of. What is it that you are looking at?
Yes, always for any portfolio, whether it's individual or family office or corporates, I think diversification is a must. Of course, for a family office, liquidity is the second major requirement and concern, which has to be kept in mind. And some of the products don't offer liquidity. For the sake real estate, some places yields are good, but finally, when you have an asset which can't be diluted overnight, the yield really doesn't matter. So we have to be mindful of it, and especially for a family office which has been existent for last 18-20 years. As the promoters shift from generations, I think liquidity matters the most for us. And also the other asset class. So debt is completely evolved. We have schemes and product lines which caters to all durations, all categories and all that. Equity also, we have multiple schemes in terms of large, mid, micro, and all those things. And the other ones are commodity, which I think if you're a commodity in the commodity business as such, there is option to play on the commodity side. But if you really want to hedge your portfolio with commodity, I think other than gold and silver, which has been recently launched, you don't have much of an options available. Yes, through this panel, I'll be happy to take suggestions there. But no, we have been high and low on looking around for options, but we haven't had too many successes. And obviously, we cannot hold physicals for whatever reason it is, highly prohibitive doing that. So we want liquidity. Paper equivalent is the best option available. Going on to say Bitcoin, ESG, and other thing. Bitcoin, really, it's a choice one has to make whether he wants to do something, and it's more of a personal nature, not of a corporate or a family office nature, because the regulations in various geographies are just evolving. People themselves know, the regulator themselves are clueless as to how this operates and how this happens, and if there is money in the wallet and password is lost, can you retrieve it? And there are so many regulatory issues, personal issues, transactional issues, ownership issues, identification of ownership. And then ultimately, when the regulator come by and swing by and knock at a door, they need to see document which says you are the owner of X or Y. If it's not clear, they have a whole lot of surprises on us. So we are away from Bitcoin very clearly. ESG and impact again is a question of depth and availability, and what exactly do you want to be part of. Because environmental, social, yes, you can. These are nice labels, but when you go deeper into it, like morning, I was listening to one of the panelists talking about. They are in the real estate business. It's a very on the ground business. They have to cut down few trees. They have to cut down. They have to pour cement. They have to make steel. So how do you call them environmentally friendly? They can put some rooftop panels on the solar system, but you are not going to give him that credit for it. And then ultimately the consumer who has to pay for all these facilities, and they have to be feeling proud of it. I think Indian consumer is far behind in terms of social commitment. We don't keep our wrappers in our pocket. We throw it on the road. You see, so we haven't evolved to be a yes compliant economy yet. Yes, these both brings growth and sustainability and all those things, but we have come around doing those things properly. So I think an impact also, yes, the concept was there in the previous organization we were funding organization which brings in impact into the society, but we couldn't go too far because the understanding behind that was very far less. Even the seasoned venture capital and private equity guys did not believe that this is going to take shape anyway. And then we had really rough 2 years there. So I guess these labels are nice and good. It evolves over a period of time. We'll wait and watch until it is a full circle, and then probably we'll try it out. And that too, I'm not certain that we will be having a significant portion of this. This will be tried out after it is fully evolved there. So that's how I'm looking at the various diversification opportunities available. To that extent, as of now, yes, we have commodity to the extent of gold and silver, and equity and unlisted space also we have. That's also a good diversification possible. Good businesses are available today. Of course, mindful of the valuation that's been asked around, but that is, as we said in the opening remarks, it was plenty of liquidity. The people who are having not one, not two, multiple venues for diversifying, throwing money. So I guess that was the only big challenge. But slowly, as liquidity dries up, we will see a period of people having normalized expectation on the private equity side also, or unlisted space also. But we are there. We will make that book large enough. But today we are there as well.
Right. No, as you rightly said, I mean, there are little dearth of options in India, particularly when you think of ESG investing or impact, only few ETFs or funds wherein one can take an exposure. But if we go globally, then yes, we can still see a lot of options, but obviously obviously then one has to be mindful of currency risks and other things as well, and in terms of what we are in terms of our overall exposure, what we can take in global exposure. So I mean, if I ask you, Mr. Rajesh, even with Sudhindra ji brought a good point of liquidity. I mean, looking at current times, liquidity I think is becoming the most important factor, wherein everyone is trying to create liquidity to take advantage of this unforeseen circumstances which has come of geopolitical risk. What are your views now in the current juncture? What should one look at? I think you are on mute, sir.
Yeah, I think right now, can you hear me now? Yeah. So I think
Yes.
right now, given all of what has been said and discussed, that we have a certain geopolitical situation that we need to handle, or we are confronted with, which has been unpredictable, but I guess it's now on us and we need to now handle it in a particular way. I feel there are going to be quite a few risks across asset classes. You cannot see a single asset class that would actually stick out in the current situation where you can say, okay, let's go to this asset class. Because even if you're looking at fixed income right now, fixed income itself is going to have quite a few pressures. You're going to have interest rates going up. I'm not saying in India alone, I'm also talking of global markets. You're going to see pressures on liquidity. You're going to see pressures on input cost. So I think right now it's possibly a time to close your hatches and sort of remain invested in an asset class that you understand the best. And to me, we'll have to increase the allocation to the fixed income space. I'm talking of a situation where family offices were steadily increasing their allocations to equity, will have to sort of pare down their exposure in equity and look at fixed income and remain at the short end of the curve, remain in those products which are having a very shorter duration, so that tomorrow, as and when the interest rates increase, they are able to catch the upside at that point in time. So I would also tend to look at AIFs and REITs. REITs essentially because REITs are stable. They are essentially underwriting the rental income. They're not looking at office space, investment in office space per se, but they're looking at rental income. And I would also look at AIFs because, like one of the other panelists said, there are a lot of interesting investments happening in early stage companies. So AIFs are looking at those investments, and they're being monitored fairly well. And all these are investments for the longer term. So where you're paring down your investment in classic equity to increase your allocations in AIFs and REITs, possibly this seems to be the good time. I'd also look at InvITs, which has become the flavor of the day. You have a power grid InvIT, which is doing reasonably well, and you now have InvITs being launched by some other organizations, which also need to be given a serious consideration because InvITs also are playing out favorably in the current market. So that's my take.
Correct. In fact, as you brought out Power Grid, even IndiGrid, all these InvITs are, apart from delivering those 9-10% kind of annualized inflows, are also now trading at huge capital gains. Like if you look at them trading in the listed markets, investors are sitting at good capital gains. So yes, it looks like an alternative to a conservative fixed income space wherein one could look at exposing themselves to InvITs and REITs with relatively lesser volatility and mark-to-market risks.
Yes.
So, and even as you talked of startups, Benafer, you've been LP to various funds and have also invested a lot in this space. So how evolved do you think is the current ecosystem when it comes to startups as compared to early 2000s? And where do we stand in terms of our global startup ecosystem? How do you look at that space?
So startups and everything related to early stage investing has been something we've been doing for the past 10 odd years. As you know, the group that I manage were one of the few early exits of businesses which happened way back in 2010 when business exits were not really so common. So we set up our first fund in 2011, and that's on maturity as we speak. It's going through a lovely phase, I would say. So the system has definitely, changed leaps and bounds from where we started. Startups, if I can give you some numbers, and I know you mentioned a few in your introduction as well. I read somewhere that 2014, we had VC funding of about $5.5 billion. That itself has gone up, like you mentioned, to 38, but the latest report is $42 million on 2021, which is across 1,600 odd companies. So the growth from 2014 onwards, especially the Modi era, if I can call it that, has been phenomenal. Also because of the government pushing this whole ecosystem to a new level with Startup India and everything else that is Invest India and everything that they've been doing as well. This phase also saw a lot of offshore let's say professionals coming back to India, right? I mean, this phase of the return of the brain capital back to the country has actually caused a lateral shift in how the system has evolved, because they got the best practices from what they were seeing in offshore markets, whether it be US or any of the other major countries, and they came back and started trying to set up funds and companies into this, fueling the fire in the ecosystem, as I can call it. So exits wise, 2021 has seen about $12 billion of exits, out of which about $4.5 billion have been of IPOs that we've seen, very successful ones. Of course, we've seen what has happened to them post in this phase. But in my view, and of course, secondary sales has also been about $1 billion. So it's not that IPO is the only way, and M&As have happened about $6 billion. So the whole ecosystem has evolved to a very, very large extent. In my view, this whole ecosystem is only here to grow. I think the next 10 years, we will see a completely different Nifty table, if I can call it that. And that is what we are playing towards. We want to see some of these companies become Nifty and Sensex companies, which is likely to happen. And I think the earlier you participate in it, the better you'll be.
Quite true. In fact, if we see even during pandemic years, the inflows in the private markets was huge. Though FIs, institutional investors, were selling in listed markets in the last 6-9 months. But the inflows which we've seen in private markets has been humongous. I mean, they've been quite resilient even during these tough years. So I think this is one asset class which what family offices have to look at in terms of a sizable exposure in their overall assets, right? So when I take this point forward, Sudhindra ji, I would like to ask you, which are the sectors that you foresee in the startup space, fintech or edutech, health tech, where do you see the bigger opportunities, and what do you think should be the due diligence process which one should look at while investing in a VC or a PE fund? Or
I think I'm little my little favorite is a health tech, because I think healthcare as a sector has been kind of taken a back seat for a long time, especially the size of India. I think that the tech is going to replace the requirement of the gap basically between the doctor-patient ratio, because that's I don't think so. Next 10 years we'll be able to bridge that gap, even if all the people who write the NEET exam kind of qualify overnight, So I think the med tech is what is going to change a lot of things for us. Fintech and fintech and edtech has come of age thanks to Corona. I think the edtech has kind of squeezed and become larger and larger and larger. I think all the models of edtech is kindly on the table for everybody to do. Fintech also to a large extent now. The next fintech idea comes up is something similar to what was tried, tested a few years ago. It has taken small shape and small leg up, but nothing significant is really coming up. If at all is there anything, it is kind of ease of doing business in that space, or or bringing in more pool into the ecosystem, which I guess eventually the private banks and other people will bring in, because I think that is their business model and the game plan. So the new guys are not going to really add any value significantly. There may be one or two, yes, but none significant as that has happened so far. So that is a space that I'm looking for, and a few other things which are kind of service oriented businesses, which will be going towards an technology oriented business. I think as in the Western world, we see in India also, we are finding it hard to find people to service you, me. I think eventually the Zomato, the farmer's son has become a Zomato driver today. The Zomato driver son will eventually become somebody else tomorrow. So there'll be gap created in these spaces of service industry, and we need something to plug in those spaces. I think somebody will come in there to help you to sort it out, as that has happened in the Western world. And in terms of due diligence, and what we look for is basically the business model and the promoter behind that. If both match together, I think there is a success story written on the face of it. I think that's how success and stories are written. Because if you take any business model around the world, it has to be the person behind the seat, because his wavelength has to match with what he's turning around or what he's thinking to bring it on the table. Eventually, that's how it makes it to a larger screen, larger play, larger audience. If both doesn't sync, or the audience don't sync with the hero there, it doesn't work. So so we really look in deeper to understand that the business model is fulfilling some requirement, or some filling in a gap per se. It fits in there, and the person behind the scene is firmly there in the driver's seat, thinking about it, putting in things in shape. I think it will be a short success forever.
Right. Yeah, rightly said. I mean, we need a hustler who can just come and back up the business opportunity which is there, right? I mean, there could be hundreds of startups running the same idea, but at end of the day, it boils down to the promoter being a hustler or not, and will he be able to push that business forward or not. So Rajeshji, when we even look at this space, so when you look from your family office perspective, what is your recommendation? Should investors be looking at the fund structure? Should they be looking selectively to invest privately into startups? And what is it that requires in terms of skill sets to identify the startup? I mean, there are a lot of startups. So what skill set one should look at while identifying these soon to be unicorns? You are on mute.
Your first question, that should a family office invest directly in a startup, or should it invest in a fund? That is what we just discussed, or an AI, sort of an AIF type of a structure. I think it has to do with the risk appetite of the family office concerned. I'd also like to add on a bit on impact investing, which is now gaining stream with every passing day. So there are family offices who believe in a particular cause. Let's say green energy. There are certain family offices who believe that green energy is the way forward. Now, if they believe that there is a particular startup idea which makes sense and is completely up the green energy street, then they would be far better off investing directly in that company, because it meets a dual objective. It's more like a semi-philanthropic effort of theirs in trying to get into something which interests them, and also they are getting into the investment at a very early stage. However, if it's outside the realm of impact investing, I would tend to caution, or I would prefer that the family offices look at investing through an AIF route. That is where a fund is created, and you have a set of experts who are examining investments, who are closely monitoring investments. Most importantly, not just investments, but what one of my fellow panelists said, also monitoring exits. Because if you have a set of investments on your plate, you have to ensure that over a 3 or 4 or 5 year period, there are exits happening. even if you're not exiting the company completely, even if partial exits work, because that's the only way in which you can ensure cash flow. So I would say that outside the realm of impact investing, stick to investing through the fund structure. In fact, now you have certain alternate investment funds which are also allowing you to co-invest. Meaning, if the investment that the startup is seeking is of a particular order, and you have contributed to a particular your contribution to the purposes of a particular order, you are allowed to be a co-investor. So you have a flavor of not just investing through the fund, but you also get your rights to invest directly as the co-investor. So that's the model that I would recommend to family offices. In terms of the skill sets that the team should have in identifying the potential investors, I would say it's more, I wouldn't have too much of weightage on the financial or commercial skill sets. I would look at people who are experts in the technology domain, because right now, most of the investments that are happening have a technology edge to it. So I would prefer people who are qualified and who have the expertise there, because commercial and financial knowledge of a particular deal or advisory around a deal is available today. It's something that you can either seek advice on and have your small team within your fold to close out. But it's the technical expertise that you need, which in most family offices is missing, because the family office tends to be more financially and commercially focused. So I would tend to add 2 or 3 people who have a technology edge to the team to make it more sharper.
Right. No, yes, as we discussed, technology, I think, is becoming the new capex, right? I mean, everything, when pandemic has pushed it further. I mean, these spend that we are seeing from corporations on technology is gone up to another level. So I think the technological disruptions is what one should look at, and the space which will gain most out of it is what one should look at to invest into. So even whenever, as you're talking of a lot of these startups now going through IPO stages, we've seen few listings, post listings. There have been few issues in terms of their capitalizations coming down. So do you think there is still an opportunity to invest in pre-IPO funds, or one should still look at early stage investing? I mean, what is your thought process on that?
So I would think that, I mean, to a sophisticated office which has, the bandwidth and the ability to sift through deals and kind of reach an outcome, my sorry, can you hear me? Yeah. My suggestion would be to definitely, propel the team on the early stage investing. One is because it's very, very satisfying to see, your early stage companies reach the next stages and get funded as investment professionals and as families who are promoting those companies as well. That's one. But one thing I want to highlight very clearly, and this applies to both, whether it's a pre-IPO stage, AIF fund which is investing in the company, or a family, or anybody. We strongly look at the promoter on who is going to be behind the company, irrespective of their, what should I say, their learnings, their background. And we also assess very clearly how strong are their networks. Because I think in business, what we have seen is companies normally start over with a particular vision, and they will want to achieve something, and they will, I mean, it's a beautiful, so we don't invest at proof of concept stage, you invest at where there is a revenue stage and you move ahead from there. But in my experience over the last 10 years, I can assure you that the way the businesses start and where they land are completely different things in due course. So we have seen business models change 3 to 4 times, and suddenly you'll find that one idea is a unicorn idea, And that's where it's catapulted into the next league, if I can call it that. And that's a total evolution of how committed you are to the company to bridge it through the times when goings are tough. And that is one of my key learnings. You will find an idea attractive, whether that idea actually culminates into something as envisioned in the beginning. Maybe only 5 to 8% of the companies will actually achieve that. The rest, 95%, will go through their evolution and will change their business models. Case in point, if you see Nika today, where it has started and what all it is offering to the customer now are completely different things, right, from where it began. So that's the analogy I can draw for you. Whether pre-IPO funds or no, yes, we have a mix of both. I don't think you can catch it all. What I think pre-IPO funds can do is give you economies of scale, which is not possible as an individual investor. So it is not possible to be part of every deal and kind of have the upside. So you might as well find a little bit of hedge where you participate in them because they have the volumes for which the companies would come to them and seek capital.
Right.
I'd like to add here, if I may.
Yeah.
It's a question of filling in the gap, as Benifer said, that if the bandwidth is available in the family office, and of course the family office's focus also matters here. In a space like ed tech or med tech or deep tech or space tech, there are very few players in the market who can understand this technology much deeper. I think that way, if AIF has the skill set, and today the AIF can collect 300-400 crores easily, thanks to Driven. I think that's a better route to go. And if a family office has a specific set and they want to explore that because they have developed it over the last 20, 30 years, I think that both the models are perfect fit of it. Of course, the drawback in terms of AIF is that the touch and feel is lost. And second is the duration of the product. The AIF business itself is 10 years plus, and they always come back to you with the extension of 2 years kind of stuff. And end of the day, you don't see the real nurturing of the startups through AIF structure. I think family offices are not yet divulged from operating a business and monitoring the business. I think somewhere they want the touch and feel that has happened. I think that would be my add-on here.
Yeah. No, even obviously when family offices look at investing directly, obviously there is a huge bandwidth required in terms of setting up the team, doing the due diligence at their end. There's a lot of legal documentation process and everything, obviously. Then it becomes a separate part of the family office altogether, right? So family offices should look at that from that perspective. So setting up a separate wing and allocating capital to that proportion to actually help that generate a sufficient alpha in their portfolio.
Agree.
Also, I mean, another asset class which you've seen being quite resilient in last few years has been these long short funds, hedge funds. So what do you think, Sudhindraji, is your take of these investments into overall asset allocation for the family offices? Where do they stand? Do you invest particularly in them?
Yes, we have tried that product as well, because it's kind of a hedge that can be done, because as a family office, we don't have the expertise to do certain things ourselves, and especially hedging the portfolio. I think all the panelists here say commodity is one thing possible, but clearly the depth is not there, on the breadth is not there in that. So equity long short has been one option that has been clearly available. We have tested it, but then it really doesn't work as a hedge. At best, over a period of 3 or 4, 5 years, it has given us a return of about 8.5-9%, which is anyway available if you're prudent enough in any large cap portfolio or a mid cap portfolio or an ETF portfolio so far. So really, it doesn't act as a perfect hedge, because I think the problem is the regulations around this space, the availability of long-term futures option segments, availability of the spread in the market in terms of the number of stocks available to hedge your portfolio, and how because I think internationally naked hedges are possible. I don't think that India is yet there in terms of creating naked hedge. You have to have a covered position. Then the whole scheme is lost. You can't have both sides winning always. So somewhere you have to. So hedge is what? If you lose the other side, you have to win the other side, right? Basic, simple logic. But we don't have that breadth and depth available. And somewhere I think regulator is really worried that if I allow people to go haywire, I will lose control of things. And I think we are economy which really want to have the control in somebody's hand. It doesn't matter if really we kind of control things properly, but the control has to be in somebody's hand.
Yeah.
I think that way there are options available. We have tested it. We haven't had significant success. Maybe I looked at the wrong product. Yes, I don't know, but it hasn't really helped. But it is a product really needed today in the market. As in a debt product, today there are plenty of AIFs available, which gives you that 3 or 4% alpha over a credit risk fund with the same amount of credit risk that is available, like a bond fund, AIF structure 3, which structure 2, available, which gives you 12% return. I think many of you would have participated in that. So am I. And it has consistently given me that coupon 12% with hardly a percent half of risk, which is very good for me, because even if I take the percent half, it is 10.5%, which is very good for a portfolio which is today majority is yielding 5.5, 4.5, 5%. And on top of it, you have a 25% tax on it. So the gap is still 4-5%, which is very good. So that is the gap that needs to be hedged today, and the long short funds doesn't provide for it.
Yeah, exactly. I mean, even at our family office, we've taken routes of investing into these long short funds, and even, as you said, structured credit debt AIFs. I mean, so long short funds traditionally have given these 8.5, 9% posted, but what we look at it as separately is an asset class in between a fixed income and an equity, rather than as a hedge to a portfolio. So I mean, if you're looking somewhere to bridge the gap between that space wherein we can get an alpha over and a real rate of return in the current environment, then yes, these hedge funds suits perfectly. And the credit structured AIFs, obviously they carry a similar risk to what a credit mutual fund would do, which we've seen, and still give you an alpha of 2-3%, which I think is prudent enough for family offices to look at selectively.
Correct.
So what, Rajesh ji, has been your approach to this space, and if I may ask?
Is in mute.
When you're saying phase, what did you specifically?
In terms of investing into long short hedge funds and maybe even AIFs on the credit space.
No, I think generally we have not looked at this space quite simply because, like you said, when you're looking at investments which fall within the equity and fixed income space, we would generally prefer looking at maybe in the fixed income instead of traditionally looking at AAA plus type of papers, go to AA plus was the general view, where you may get a kicker of 1.5-2% extra return rather than going down the hedge fund route. Now, of course, if you ask me going forward, will we do that? The answer is no, because you have credit becoming a concern, or will become a concern very soon. So we'll have to get back to the AAA type of thing. But I guess our approach has largely been to stick to fixed income. And if we wanted to increase the return a bit, we go down the route of looking at AA instead of AAA type of papers. That's been the broad approach. But thus far, no exposures to hedge funds.
Right. So Sharon, do we have any questions from the audience? If we can take that up in the interest of time, because I don't see anything in the chat box. Else we can give the concluding remarks.
Sharon is on mute.
So I would then like to conclude the session and leave some remarks. If we see the equity valuations have been at record highs, and I think investors have to be very selective to achieve risk-adjusted return, not only in current year but also in the next few years. Right? These geopolitical can have significant impacts from an Asia Pacific perspective also, particularly. I mean, impact of high energy prices and possible sap in global demands for Asian exports could be there due to stagflation risk in major economies. In near term, there could be a risk of sentiments as well when investors should look at safe haven assets like gold, USD assets, and everything. But yes, alternate assets like PE funds, VC funds, and hedge funds should form a reasonable part of the overall portfolio, not only to maximize the returns, but also to provide a hedge from a lot of these uncertainties. So we've at our family office also have taken similar routes of investing into startups through funds, through direct co-investments as well. The choice depends a lot upon the capital allocation, the time frames, and the risk appetite, and also it also depends on the bandwidth of the family office to be able to do due diligence. So these startups can also, I think, be directly or indirectly strategic to businesses as well, and also provides opportunity to work with founders and to support entrepreneurship in the country. I believe the regulatory framework and business environment has also improved over the years, and promoters have been able to access capital with relative ease. With so much liquidity being there, I think valuations have been skyrocketing for a lot of these quality managements and startups. And again, the point which we discussed, I would like to put forward is that 90% of our portfolio returns come from its asset allocations. And family offices should keep their investment philosophy and mandates in mind and should not get swayed away by irrational returns in any asset class in any particular year. So, discipline in investment and risk management should be the core pillar and it will help in delivering strong adjusted risk return. So, with this, I would like to conclude this session and thank all the panelists for a great discussion and look forward to the another sessions. Thank you.
Thank you.
Thank you.
Thank you.
Thank you so much, Puneet, for moderating that so well. I think it's been a fantastic discussion, getting so many diversified insights from Vinayaka, from Mr. Rajesh, to Indra. I think it's been a fantastic having this session. So now we move on to a quick break of say by 1:30 we'll be back on the session, and we have a very exciting panel discussion coming up on legal tax and also on government's risk and compliance. I request all of you to stay logged in and revert, and we'll start off with the session at sharp 1:30. Thank you.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Good afternoon, everybody. Welcome back. We start off with the next panel discussion on the legal, tax, and regulatory management for family offices. Please join me in welcoming our panel moderator, Mr. Vikas Agrawal, a Vice President and Head Tax from Home Credit India. He brings in 20 plus years of enriching experience in taxation, accounting, auditing, both in consulting and industry. He's also worked with organizations like GE, American Express, and PwC. A warm welcome to Mr. Sumesh Dhawan, Sumit Rathi, who's the Chief Financial Officer from NG Solar India, and Mr. Ashutosh Dhawan, who's the Group CFO from Mankind Pharma. A very warm welcome to all of you, and over to you, Mr. Vikas.
Good afternoon, everyone. I hope I am audible.
Yes, you are.
Yeah, good afternoon.
Yeah, hi.
Today we are here to discuss a very interesting topic on family offices and the related tax strategies. So, as the introduction has been given by Mansi, so, I have got my two esteemed panel members here with me, Sumit Rathi, who is a CFO for NG Solar India. Hi, Sumit. Welcome to the forum.
Hi, everyone.
And I've got Ashutosh Dhawan, who is a Group CFO for Mankind Pharma Limited. Hi, Ashutosh.
Yeah, hi. Hi. Good afternoon.
Good afternoon. So, let's start this discussion. First I'll give some background on this subject. So we are here to discuss the tax strategies related to the family office. We all know tax is a dynamic subject, and especially in the last 5 years, we have seen some big tickets developments in this area. This started with GST rollout in 2017. That has been followed up by GAR implementation starting 2017-18. GAR is General Anti-Avoidance Rule. That is followed up by corresponding treaty changes in the international tax that is triggered by the multilateral instruments. This started in 2019. In 2019, one big event that we have seen, which was unprecedented in India, was a big reduction in the corporate tax rate that we have seen. And in 2020, again, we have seen big tax development on the dividend side, where there was a scrapping of the dividend distribution tax. And now the dividend is taxable as normal income. And it would have different implications when it is payable to non-resident, because the treaty would be applicable there. So in this backdrop, when we see so many changes time and again, and those are the big ticket changes, it becomes imperative for one to ponder on the tax strategies for all organizations, including the family offices. So my first discussion point here would be to deliberate on the structure for family office. So here I'll ask my first discussion point from Sumit. So Sumit, how should the family office be structured as per the current and emerging tax regulations? So what is your view on that, Sumit?
See,
as you have rightly said, it is quite a lot have changed since last few years, especially in tax and all. And family office now are becoming very important in India also. They are growing. There are a lot of startups coming up. So it is very important to have a proper structure which is more effective for the business. At the same time, it is more effective from tax point of view. There are two forms. One is trust. In trust also there are various forms of trust, and the other one is the company structure. So typically, if you see in India, for the Indian businesses, business house, family businesses, trust has been a very trusted mode of having this family office structure. But nowadays, with globalization, with a lot of HNI, with a lot of non-residents also expanding, coming to India. In fact, Indian families expanding and going abroad, staying. There is a way to reevaluate this structure, whether company structure, the holdco structure under the companies is important, or whether it is more tax efficient. So yes, it will depend upon all the different types of structures, but evaluation has to be done, especially now when in the growing Indian market with so many startups coming up and more coming in down the line, and they want to have they want to structure the business, it is the right time to evaluate this type of structures.
Absolutely. You raised a very well point that, considering these changes, perhaps it would be a good strategy from tax optimization standpoint to review at the structure. I don't know whether, one can tinker with the existing structure. One has to look at the implication. I'll come to that later point in time in this discussion. But yes, structure can be relooked, especially for the new, family offices that are being set up, or the new businesses that are being set up. So very well point raised, Sumit. Ashutosh, what is your view on this? Do you agree with Sumit? And if you want to add anything on this point?
No, certainly. The tax plays a very, very critical role, because if you look at the whole landscape of taxation, and the tax arbitrage or the differential is very high. And if you want to have an additional alpha, so tax planning plays a very, very important role. And so I can't agree more than what Sumit has mentioned and you have mentioned, but I would like to add few aspects to the structuring aspect, basically. The family office structure predominantly revolves around 3-4 key pillars, I would say. One is the succession planning, because as the size grows, family becomes big. So succession planning becomes very, very important, and where the trust plays a very, very important role. Second is that how the investment thesis, or what is the investment policy of the family office. Is it aggressive? Is it conservative? Is it a mixed approach, or normally it's a factor of your liquidity, safety, and return. And third, as Sumit has rightly pointed out, that nowadays the strategic part is also becoming very, very important. A lot of family offices are investing in the startups or in the funds which in turn is investing in the startups. So these are some of the rationales, and I would say the headline is that the tax efficiency plays a very, very critical role in this, because if you look at the company, so there also tax rate varies from 17% to 25% to 35% when you are taking exemptions and all. And in the case of individual, the maximum rate is 43 odd percent. And they are also depending on the investment vehicle or the type of investment. So the tax varies. Even the short-term capital gain varies from 25% to 33%, where in which vehicle that resides. So yes, so tax planning is one of the critical part, but my limited point is that this tax planning needs to be looked into a holistic manner and when you talk about the structures, the I would say that basis my experience around developing structures, one should keep in mind some of the factors. So one is that what type of asset classes you have: real estate, mutual fund, AIFs, painting. So that asset class, investment asset classes is important, and then mapping those investment classes to the vehicle, that because entity wise also the rates varies, so mapping that those investment classes depending on the tenure and the liquidity requirements, so they can be mapped to the investment entity vehicle. And that type of combination is something I would say that will work very well if while designing the structure. So these are some limited points which I wanted to share. And yeah,
No,
Vikas.
thanks, Ashutosh. These are insightful points. So you raised there is big difference in the tax rates when it comes to asset to asset class and structure to structure. So in a corporate where you can see a tax rate of 25%, and in a trust structure it could be 43% also.
Correct.
Quite range of difference. And also there is no structure which is one size fits all. It also depends on the facts of the case, what type of asset class you have, what type of strategy for business you have, what are your prime commercial rationales that you want to achieve in any particular fact pattern. So all this would decide and have impact on the structure decision.
And because Ashutosh has rightly said that succession plan is one of the very key important factor, and
Right.
that do play a very large role. It's just not income tax rates, but stamp duty, SEBI takeover code, FEMA regulation. If you have an non-resident, whether they can invest into land. So all these factors play a very big role while taking a decision. So it is not that simple because trust itself comes with a very complex structure with multiple trust type of structure when the family grows and when you have multiple businesses and all those things. So you have to have a right balance with some flexibility to adopt to the new tax changes. And in case like Ashutosh rightly says, key points where like succession plan, what are the asset class and tax we discussed, but also now with this globalization and all, whether there is a future plan for some sort of liquidate, unlocking the cash for the business by doing some disinvestment at certain levels, so that the family can expand into or invest into future group. So all those types of decisions will take an important point.
Correct. I can't agree more than what Sumit has mentioned, because in family office, the typical part is that it's quite different from the regular company setup, where you have companies and either a public company or a listed company or a private limited under that. So that's typically the corporate structure is. Whereas in family offices, the uniqueness is that it's a combination of various type of entities. You have individuals, HNIs, you have LLPs, you have partnership firms, you have trust, then you have NBFC setup, CIC setup. So all type of different, may not be magnanimity, may not be high, but still that complexity is there in terms of widespread nature of the ambit which falls in the family office. So that's important. One of the factor to look at that how you organize the entity structure, which asset should reside where. If it is a real estate, whether it should be part of a company or a trust or whatever. So depending on the stamp duty and the liquidity, all those aspects. So these are some of the other factors which also plays an important role while designing the structure for the family office.
Correct.
And one more thing, nowadays, the new thing which is evolving is the type of structure is could be either inbound or an outbound. That the outbound structures are also becoming quite prevalent, especially after pandemic. And moreover now with Ukraine-Russia crisis, so country risk mitigation also plays a role, and so And the other aspect could be the wealth creation outside to support overseas businesses. So the outbound structures are also becoming quite prevalent nowadays. But to add to that, the tax planning is becoming quite challenging because of the global minimum corporate tax, wherein I think 125 plus countries have agreed for a minimum tax. Now even Dubai has also committed to that they will be coming into the taxable regime of 15%, I think by 2023 or so. So no more tax havens in terms of tax planning and all. So world is becoming quite rationalized in terms of tax planning aspects.
Yeah, one point that I can take out of this deliberation is that as far as possible, one should strive that trust. The structure should be whatever it be, should be having flexibility to take care of the future changes that are going to come.
Yes.
So now we all would agree that once you go to a particular structure, it is always difficult to go for changes. There would always be implication, be it legal, tax, regulatory. So now in the changes that we have seen in last 5 years, especially the GAR, what do you think? Do the family offices would have any sort of flexibility in migrating from a particular structure to a different one? So Sumit, what is your view on this?
So definitely it will be not that easy. So if you are changing the structure and all, you need to have a business rationale for it. As you are aware, GAR is becoming more and more important. And with multi-trust structure also, even though it is a very well settled explanatory given already by the authorities that for multi-trust structure, you can form as many layers as you can, but GAR is not applicable. But over a period, I think it will be tested. This is something which is very important. And so having a business rationale for any decision is very important. And it will become more and more complex, rightly said, because earlier that is it easy for already established structure which the family has adopted to move to another structure? Then that will play a big role. Why documentation will play a big role for having that.
Perfect. So Ashutosh, you want to add anything?
Exactly. No, certainly, because GAR has become now a reality, I would say, and it's a cornerstone of all the tax planning. But as Sumit has rightly said, the business rationale, the commercial rationale is very, very important. And one has to make sure that there is no misuse or abuse of any of the provisions of the Act, either directly or indirectly, so to say. And the now with every tax planning aspect or while designing the structure, GAR has to be taken into consideration. And so the lesson is basically the earlier the procedures used to be more important than the substance. Now things have evolved and the substance has become more important. And there has been the principle has changed that you have to the compliance has become important. So GAR is of paramount consideration while taking care of any of these tax planning structuring exercises. Yeah.
So Ashutosh, you have raised a very important point that now we are sort of migrating from form to substance, whether it is domestic tax laws where GAR is there now, or whether it is international tax laws where we have seen treaty being changes as triggered by the multilateral instruments rollout, where 100 plus countries have decided to amend the tax treaties to take care of the form perspective, substance perspective. So this is a very important point. One need to see at the time of setup also for any structure, as well as if they want to propose any changes. We as professionals need to take care of the aspect that, every decision should have a commercial rationale. Tax should not be the, driver of the discussion, of the decision. So that may take me to the, next discussion point, which is on the best practices. So, we have talked about the structure aspects, the strategy that play a role in terms of, tax optimization. But only strategy is not something that can help any organization, be it family office or any corporate. There has to be certain tested best practices one can look at and try to implement in the respective organization. And these practices perhaps are common, whether it is to do with India operation or whether it is to do with overseas operations. So my first question would be to Ashutosh. So Ashutosh, generally we have seen in big corporates, the multinationals, we have seen that generally the tax management is driven by a tax policy. Generally, it is at a global level. The group, make a policy, and all the entities, operating from respective jurisdictions need to be, operating within the framework of a tax policy. So, should there be a tax policy for at a family office level? What do you think?
So certainly, policy is definitely plays an important role because monitoring and the governance aspect is very important. The tax policy is very clear. I mean, to pay the correct taxes. So that's the simple one-line policy that not a single paisa more of tax and not a single paisa less of tax. It should be the correct taxes. So that's one, you can say, a headline statement. So as to the corporate, like you have the targeted ETR, and the organization or the tax department works towards achieving that targeted ETR. All the appraisals, etc., are linked to the ETR factor, which is the effective tax rate. So similarly, on the similar lines, because whenever as I mentioned earlier, if some delta or extra return is required, so then tax planning plays a very, very important role. Simply from short term to long term, you save a lot. 20-25% of straight tax arbitrage is there. So similarly, some benchmarks, some guiding factors, some policy, so that should be there at the family office level as well. And on the hindsight, no aggressive position should be taken, because there it's not a corporate, it's the individuals who are part of the family office setup. So one aspect is that as far as feasible, the no aggressive position should be taken, consistency should be maintained in terms of policy parameters, and one should clearly evaluate and analyze what type of potential exemptions are available and how to take the best benefit out of same. Yeah, so coming back to your point, yes, tax policy is important from the family office standpoint as well.
Perfect. Yeah. And I'm taking one clue from what you have described here, the consistency. Consistency not only in the tax policy, but also I think tax positions, because family offices may have many businesses operating out of multi jurisdictions. So what is the role of tax positions? Should there be consistency in the tax position across the entities? So Sumit, this is my point from you. So what do you think? How should one strive for consistent tax positions, and what role it is to play in tax optimization?
I think consistency is very important, and we should take, I'll say, even government is in this budget went with consistency, with having consistency in tax laws and regulation. There is no complexity, changes every year and year. And the same thing applies for our structure. See, family office has multi-layer, multi-businesses structure, which can be very complex. having a tax policy, as rightly Ashutosh has said, is very important, and it has to go from top to bottom, tax policy. At the same time, when we are talking about consistency has to be there, not only in the same entity, but in across the group. When you are taking stands on tax and any specific points, because documentation, as we discussed earlier, documentation is becoming important day by day. All your decisions, all your stands which you are taking, you are going to document that, and you cannot have inconsistency in that. Year on year you need to have consistency, and in the group itself also you need to have consistency. This will help in assessments, this will help in all tax litigations for sure.
Perfect. So now you have helped me to go down to the next best practices, which is the documentation, the role the documentation plays. So, we all are privy to the tax positions that we take on day-to-day business basis. But, these tax positions come for a scrutiny years down the line when you receive any notice for audit or assessment. So, at that point in time, it would be very important to defend that tax position, and that defense can be through documentation. So, Ashutosh, I would like request you to share your views on the importance of tax documentation and its retrieval whenever required year down the line.
No, definitely. That's a very pertinent point, because documents, they form the basis for identifying, recording the transaction, and especially in a scenario where you are having faceless assessments. Someone is reviewing, someone is checking, someone is approving, order is getting processed from somewhere else. So the only way to come to substantiate your position is the documentation. So in terms of documentation, the preliminary thoughts are that there should be a master file for all the agreements and all, so that the archival is more consistent as well as easily retrievable. The ownership documentation is also important, because that also needs to, that's a lifelong, or till the time the asset is being held. So that's important, both from the liquidity and the transfer of ownership records. So it's important to have a very coherent, consistent filing system, retrieval system, so that the documents are available. You don't know what point may come up while during the assessment, because in corporates, in the companies, that okay, the transactions are straightforward, you have a proper archiving system, there are maker checker controls are there, the ERPs are there which have auto archival processes. And whereas such a luxury is not available, so to say, in the family office setup. So I'm not aware of any ERP which has been developed for the family office, so to say. Still, you rely on the basic softwares for doing the accounting or tax filing or reporting. So coming back to your point, that the documentation, archiving is really important from the family office point of view. Yeah.
Perfect. So one, this takes me to the next question on the tax compliance piece. One of the area, or one of the objectives generally we have seen in family offices to drive centralized compliances, centralized monitoring. So, Sumit, what do you think are the benefits of centralized sort of compliance, monitoring, automation, and MAS in family offices?
Before going on to that, I want to add to what Ashutosh has said. Ashutosh has rightly said about the documentation, retrieval and all. And the only word which clicks to me, we have to be proactive rather than reactive. And that is becoming more and more important now. And how to be proactive and reactive is by way of doing timely compliances, knowing your compliances first. What are your compliances? Family structure with having complex structure, or even a corporate group which has multiple holding structure. This is true for each and every type of entity. And so in this, very important is knowing your compliances and ensuring the compliances have been done on time and monitoring them on time. So documentation and all are important for assessment, but as a owner or as a managing or as a CFO, you want to know whether all the compliances have been done or not. So digitalization, dashboards are becoming more important, and it is yes, corporates have been quite proactive in that case where they have done a lot of things, but at the same time now family offices are also adopting those, and we see family offices having a tax person, tax expert on board, and that is mainly because they are also now becoming, they have had issues earlier and they want to be now proactive and not reactive.
Right. So, as we know that in India, we see myriad of tax compliances that are to be, done by the organization. And with GST, even the service sector companies now have to resort to the state level compliances. So the compliances are on the increasing spree, so to say, even if, we hear time and again of, simplification of taxes, ease of doing taxes in the country, but the compliances certainly are on the increasing spree. So, Ashutosh, any tip to ensure timely compliances by the family offices, and also, since if you turn non-compliant, it would have multi implication. It would have implication on your funding. It would have implication on your business if, say, one is resorting to a bid level business. So any tips how these compliances can be ensured timely and qualitatively?
No, absolutely. The compliances are important, and in order to be compliant, so I would say that two cornerstones are there. One is the infrastructure, and the second is the knowledge base. So in order to be 100% compliant, so one has to have a right mix of these two components: the infrastructure and the skill set or the knowledge base. So for the knowledge base, let's say there could be a hybrid approach, wherein the one option is that the regular mundane, it's a factor of skill sets availability within the setup or outside the setup. So hybrid approach could be that the mundane regular work can be done in-house, or some specialized activity can be outsourced or taking help of the specialized subject matter experts. Alternatively, depending on the skill set, if you have a good skill set in-house available, then it can be a vice versa approach, that you have subject matter expert in-house, and the regular filing and mundane activities can be outsourced or through a bot. Bot may not be so successful in family office scenario, because for bot the transaction has to be very, very high and upstream. So bot may not be the right thing to be used, so to say. So one is the hybrid approach. So that could be one way to strengthen the family office compliances. Second would be on the infrastructure setup, whatever tools are available, making best use of those tools, so that at least mathematical accuracy is there in the information flow. So these are some of the two takes which I would like to highlight in order to strengthen the compliances aspect from the family office standpoint.
No, I like your views on that. As we know that, tax is one function where vintage is required. History has to be maintained. You're doing a transaction today, but it would come for scrutiny many years down the line. So one has to ensure that there is proper infrastructure, and the attrition issues that generally organizations face, it make more complex to maintain the history, to maintain the knowledge, and to ensure knowledge transfer. So here, hybrid tax infrastructure where you have participation of both the internal expert teams as well as your tax consultants, vendors play a big role. And also automation can derive simplification and streamlining of the compliance and documentation process here. So Sumit, do you agree with what we have discussed on this infrastructure part, and your views to add on this point?
No, I think Ashutosh has rightly said, and it's very important to have this right balance of in-house, outsource, and having the mixture of technology and knowledge. So infrastructure has to be there, good, and the knowledge base has to be there. Whether in-house or outsource is a different thing, but the mixed combination for each organization or each family house can be different. It's important to have that. And just to add on to what I'll say is why digitalization and everything makes it easy is, see, even government is going digitalized. Government is using AI tools to send notices, to scrutinize assessments and all those things. And these will become more and more important. If you have consistency, as we discussed earlier, in your positions and all, this will help in your assessment in future. And it is very important to have knowledge base, as you said, because it's see, assessment normally happens down the line, 2-3 years down the line. But if you see, if any scrutiny goes, now it can go up to 10 years. So having a proper documentation, archival, retrieval, and a knowledge base, whether internal, external, a very good one, is very, very important now.
So two points to add, Sumit here. If you have multi-jurisdictional operations, overseas operations, scrutiny can go even to 16 years. And if scrutiny is 16 years, then to fight dispute on that matter would take many more years, 16 plus many more years. And the second aspect here is that considering the digitization at the tax office, though it is helpful, sometimes it haunts as well, as we have seen the teething issues in the tax website starting this year, right? So
digitalization and automation, I'll give you a very small joke of it. In my earlier company, when VAT and all was becoming digitalized and all, I have received a notice for 1 rupee short payment of CST. See, government is spending on envelope, on the stamp and all those things just to send 1 rupee. It is digitalization. You are not using it properly. Of course, they have grown over it. And as a company, we said, instead of 1 rupee, let's pay 100 rupees, because government has spent more than 1 rupee on just sending us a notice. So yeah, it is true. Digitalization can come as an haunting, because sometimes if it is not structured properly, even basic things can become complex.
Right. And also the thing is that with digitalization, all the filings, payments are digitized, and if you stand to do the compliances at a very last day or at a very last few hours, you may see a negative surprise, right? You are up for surprise. So perhaps when one is designing the compliance policies, they should keep buffer in terms of timelines. Say, don't do the compliances on the last or the penultimate day. At least do the compliances on T-2 basis, where T is the due date, right? Because now with increased digitization, there is a lot of dependency on the websites. There is also a lot of dependency on the consultant, and if everyone is doing at the last point in time, then at times we see that the websites turn so slow or they crashes.
And I would like to highlight what Ashutosh rightly said earlier, of having a right balance of tools and manpower or a knowledge is very important to achieve these timelines. Many times we have seen companies not having proper tools and employees to handle so much of data, and it ends up at the last time. So having that balance is very important.
Right. So now it takes me on to the budget proposal of this year, where they are saying that if you are borrowing or if you have a capital infusion, so you have to ensure that, the lender can explain the source of funds. If the source of funds are not explained, then perhaps it would have tax consequences on the borrower. So, Ashutosh, what is your take on that?
No, I have a very limited view on this. I did not get a chance to study in detail, but more and more with the UBO norm, ultimate beneficiary obligations coming into existence. So the source of funds is becoming very, very important, and so that could be a fallout of the global minimum tax, because now the governments at the information, and there is a lot of collaboration which is happening among the governments, so that also increases such type of compliances. And whenever, even the I think 3-4 years budget, 3-4 years back when the budget came, so there was the fair market value concept was introduced, that if the transaction or the transfer of shares are not at a fair market value, so it will be taxed at both the hands, capital gain in one hand and the income from the other sources in the other hand. So increasing compliances, or the governments are also finding various type of means to how to enhance their revenue. So this could be a step towards in that direction.
And to ensure compliance of this, perhaps whenever we are designing our borrowing contracts or capital infusion contracts, we need to have these type of clauses where we need to have support from the lenders and investors in terms of answering these source related queries.
And I would like to highlight here, government is delegating certain responsibilities, having checks at one more level before it comes to it. Yes, this can be a little cumbersome for a very basic things, especially like our group, where we are infusing for infra projects, and only after winning the project, during the project, you have already demonstrated the net worth and all your capability to bid. And after that, again, documenting it whenever you get an equity infusion. And even though it is right issue under Companies Act, you still have to comply under the Income Tax Act. So these are really complex, but see, rules are made by government to ensure there is no leakages. There will always be certain issues where government feels 1 or 2% people are misusing it, and they want to tap that, and bigger organizations, or I'll say the balanced people, get penalized in the sense they have to do more documentation and compliance. And again, we come on to the same point that documentation is important.
Perfect. So this has been a very nice discussion. So my concluding remarks here would be that, professional tax management is the need of the hour. We cannot afford to be, penny wise, pound foolish. Tax function is no more a cost center. Rather, it is a business facilitator which has a lot of potential to add value for the business conglomerate and family offices. Family offices should have, in-depth focus on the tax strategy, compliance, documentation, audit at all stages. Tax compliance and tax documentation is indispensable, as any lack in this area may spoil all the tax strategy and can impact business in terms of reputation as well as unwanted profit and loss exposures.
Rightly summarized, Vikas.
So
very well summarization.
Yeah, anything you want to add, Ashutosh, to this?
No, I mean, it's very important. I mean, what you have said is that those are the valid points and quite pertinent in today's scenario, that one thing is death and taxes are certain, whatever you do, that you can't escape both these things. So
very well.
And what tax basically whatever tax planning one does, that's only a timing difference. At the end of the day, if you are moving from trust to the company structure, and if you take out money into your hand, either it will be a dividend or a buyback, so the differential tax you have saved on the company structure, you end up paying more tax when it comes to your hand. So tax is like a timing difference. So how well one is able to manage these timing in today's scenario, that's the key. And yeah, so that's the limited 2 cents from my side on this. Yeah.
Perfect. Thanks, Ashutosh, for the concluding remarks. Sumit, anything from your side?
I think Ashutosh rightly said, and you have also summarized quite well. I don't think there is anything else to add. And yeah, it was a good discussion we had.
Certainly.
Death and the tax are the two certain things. So with this, over to you, Sharon and Mansi. Do we have any question and answers for this panel?
I see one open question, Vikas. Not sure if this has been taken up. It's on from Mr. Kiran Datta. I'm more curious to understand the various structures for offshore investing apart from LRS route. What are some of the common structures? Has this question been taken up? I'm not very sure.
See, there has been a deliberation on this point that during the discussion that the prevalent structure is the foremost prevalent structure is trust, followed up by company and LLP. But there is no straight answer. It depends on the facts of each case as to which structure is more prevalent and more apt to that case, and it also depends on the goals and the asset class. So this question was answered in the discussion.
Great. We have one more question. Do you think that fixed income securities are tax efficient investments?
Say it again.
Do you think that the fixed income securities are tax efficient investments?
Absolutely. And see, the thing is that we have to see the implication in terms. There would be short-term, long-term tax implication that one has to look into, and the implication also, since you're talking about the fixed income securities, you're talking about the debt-related mutual fund investments, and I think this is one of the good area where one can invest in. Sumit and Ashu, add on this?
Sorry.
No, certainly. The only limited point is that if you want to optimize return on the debt investment, it is better to take the benefit of indexation, because before 3-year period, one is liable to the maximum rate on the debt. But once you cross 3 years, so with the indexation benefit, the effective tax rate can come down substantially. But in looking at today's scenario, the debt is a better option than equity. The kind of volatility is around or uncertainty is around. So that can be a good asset class to look at.
Absolutely. And any given day, I'll say it is better from having parked your money in the fixed deposits.
Correct. Great. Yeah.
Thank you.
Thank you. If there are no other,
we
can
thank
conclude.
You so much,
Thank you.
Thanks.
Thanks.
Thank you so much,
Nice.
For moderating it so amazing.
Thank you. Thanks, everyone.
Sumit. Thank you, Mr. Ashutosh, for joining. Okay, so with Family Office governance, risk and compliance best practices. Please join me in welcoming our moderator, Mr. Abhishek Somani, who's the Senior General Manager, Project Controller and Risk Manager from Aditya Birla. Joining him on the panel are the members Samir Karkate, Chief Legal Compliance Officer, Edelweiss General Insurance Company Limited, Mr. Janvijay, Chief Risk Officer, Franklin Templeton Asset Management Private Limited, and B.A. Sharma, Director, NRUPS Consultants LLP. A very warm welcome to all of you. With this, I hand it over to Mr. Abhishek Somani. Mr. Abhishek, in case you're trying to speak, you're on a mute.
I think Sharon, Janmajay and Sharmaji has yet to join in. I'm not sure whether they have. At least I can't see their name. Have they joined in?
Okay, I think they are logged in over there. They might be promoted as a panelist.
Okay.
I say Mr. Abhishek Somani logged in. Mr. Abhishek, can you hear us well? Okay, I believe he's on a call. So we'll just take a few moments to start off with the discussion. Good afternoon, Mr. Abhishek. Can you hear us?
Yeah, Sharon, I am already there. Can you see?
Yes, Mr. Balakrishnan, now I can hear you. Okay, I think Mr. Janmajay will join us in a few moments. Mr. Abhishek, can you hear us, or you're still facing a challenge in the audio? Okay, maybe Mr. Sameer, Mr. Balakrishnan, if we can just start off with a quick round of introduction with the audience, while Mr. Abhishek's, resolves on the network issue. Welcome, Mr. Janmajay. Welcome, Abhishek. Now we can hear.
Hi.
Hello, everybody.
Welcome,
Good
everybody, once
afternoon.
again. Over to you, Abhishek.
We can't hear you, Abhishek.
Sorry, we still can't hear you. You're on a mute. You're on a mute, Abhishek. If I could request you to just check your mic setting once, Abhishek, going down to the mic icon that you see on the left-hand side of the screen.
So what's holding us?
Mr. Abhishek is not audible, so I think there's some challenge out there. So he's just trying to fix that up so that we are able to hear him. Mr. Abhishek, if I can request you to log into your cell phone using the same link, I think that would help. Yeah.
Hello.
We can hear you, Abhishek. If you'll need to log off from here, because otherwise there will be an echo sound out there that would create a disturbance. Yes, Abhishek. Now can you hear us well?
Yeah, I can hear you, but
Okay, we can hear you
I'm
as well.
yep. So sorry, everyone. I think sorry for the inconvenience. I think there's some problem with the mic system at my computer. And thanks, Sharon. Hi, everyone. I'm sure the session so far has enriched your understanding of how part of investing in family offices, the tax and legal implications that one should take care as a family investment office. In this session, we would attempt to unravel the nuances of governance, risk, and compliances that you may be faced with as family investment office. The subject couldn't have been more relevant than today, when the word VUCA itself would be surprised by the volatility, uncertainty, complexity, and ambiguity in the financial market. To be honest, I often joke with my employers that though you are paying me for being a treasurer, I'm effectively playing the role of an economist, a geopolitical expert, an environmentalist, and God knows what. A war in the other side of the world or a geopolitical skirmish in your backyard can have both have same implications for your investment. An environmental calamity in Brazil. Hello. Yeah, an environmental calamity in Brazil can send the iron ore prices rocketing, or a power shortage in your geography can ruffle global coal prices. A financial default by a real estate player can have same implication on the yield curve as an adverse fiscal deficit scenario of your country. If there's one world which is truly connected in happiness and demise, it is surely the financial world. However, this connectedness also means that you feel like an Abhimanyu inside a Chakravyuh. The only way to handle this is to have a very robust, effective, and operative risk management strategy and governance structure which is devoid of human feelings and which is purely guided by the laid down policies and procedures. Well, I would like to help you on this aspect by extracting from my fellow panelists who have unparalleled experience in this field. Before we delve into this subject, I would request my fellow panelists to give a brief background of themselves. Starting with Mr. Upadhyay, maybe.
Hey, hi. Good afternoon, everybody. I think we started this slightly ahead, and we were scheduled at 2:45. So Sharon rushed me to get into the call. I received call. I had was another call. So quick one. I am working with Franklin Templeton. I have joined 3 months back this organization as a chief risk officer. Prior to that, so overall, I have a 22-year experience in financial services, primarily across investment management, credit, brokerage and wealth management, and clearing and custody part of it. Large part of my career has been on the control side, which is risk compliance and governance. And some part of my role, I had played business role, which I was a CEO for wealth management business advice. Looking forward for interactive and meaningful conversation on this topic, the ever evolving topic. There's a lot of discussion over the period, over the over the decade. A lot of conversations have happened on this, and recent past in last 2-3 years a lot. So I will cover it over to Samir and Mr. Sharma for introduction, please.
Okay. Good afternoon, everyone. Thank you for having me for this panel discussion. My name is Samir Kerakate. I am currently working with Edelweiss General Insurance as Chief Legal and Compliance Officer. I have overall close to 30 years experience. Starting with basically it has been across industries, but mostly if I have to look back at myself, then I would say it is mostly in BFSI space. Prior to joining Edelweiss, I was with the Shriram City Union Finance, Tata Motor Finance, and then prior to that, I was with Reliance Life. And prior to Reliance Life, I was with HSBC, ICICI Lombard, etc. So I have been at my major area of work has always been legal and compliance. Risk also becomes part of it. Being it is we kind of protect the legal and compliance risk and also regulatory risk that is there in the organization. So I contribute my bit as and when required to. Thank you so much.
Hello, everyone. And thank you very much for having me on the panel. My name is Balkrishna Sharma. I'm a chartered accountant and a law graduate. I have more than 30 years corporate experience, serving in various capacities and looking after corporate finance, joint ventures, and taking care of mergers and acquisitions in my corporate avatar. And of last 7 years, I have been in the investment field. That is, I have joined Nook's family office, which is one of the most evolved family office. When I say evolved, what we mean exactly is we do invest in the normal investment products, but over and above that, we specialize in investing in alternate products such as strategic investments, where we not only invest in companies, but we also provide corporate value enhancement services to such companies. So it's a handholding as well as investment. So our skin is in the game. Similarly, we also invest in a lot of AIFs where we do complete due diligence ourselves, and then we invest. We also invest in commodity arbitrage and such other alternate products. So we are specializing in that, apart from the normal equity and normal fixed income portfolios. So we have a complete setup, the in-house firm it is, where we do conduct research, we do a lot of due diligence, we do monitor, and then we interact with almost all the fund managers and then take stock of the situation of the portfolio. So it's a complete entity here which takes care of family office investments. And I believe compliance, the risk, and the governance part forms a very important part in the investment scenario. Whenever we are targeting an alpha over the returns, this alpha is chiefly depending on how we evaluate the risk, how we evaluate the compliances, and how we evaluate the regulatory aspects. Because otherwise, you don't get much alpha over the risk-free investment. So I propose to delve at length on these aspects. Thank you very much.
Yeah, thanks, Mr. Padya. Thanks, Mr. Sharma and Sameer. I am Abhishek Samani, chartered accountant by profession, having around 15 years of post-qualification experience. Started my career with KPMG Corporate Finance, then moved on to Aditya Birla Group, where I've been part of the merger acquisition team, then subsequently moved into finance team. And now I'm looking after the project controller and risk part of the business. So that's my brief profile. So without taking much time, I think I'll not hold all of you back. There are a lot of insights which I'm sure our esteemed panelists would be able to throw their light on. So one thing is very clear, that family offices have a very, very difficult task, because not only are they looking into a diverse range of products, as Mr. Sharma was explaining, unlike a corporate treasury where there would be limitations in terms of the board approval and structure of the company, the family investment offices have a lot of variety of investments which they make into, coupled with the fact that it's one of the key things which would be looked after, unlike in a corporate where returns would primarily not be the only criteria to judge your performance. So with a lot of these responsibilities comes a significant amount of risk. So Mr. Upadhyay, I would first like to bring you onto this discussion. What do you think are the key risks that are essential for businesses to survive and succeed in this environment, specifically in reference to family investment office?
Thank you for your time, and Abhishek. See, there are a lot of people who are expert on the investments and all, and I'm not the expert on this. What I have experienced in 22-year career is every organization has own protocols, framework, guidelines, risk appetite, and the risk tolerance to it. But my experience has been that the governance plays extremely important role in absorbing the shock if there are some negative things are coming it, and helping in the growth, because ultimately on the investment side, it is all risk and risk and return. It's a greed versus return you are expecting. And there are a lot of evolved frameworks around it. So there are a lot of risk measures, matrices are there and all. So somebody will say VAR, somebody will say opening as stress test, promoter. There's thousands of the criteria. In case specific to investment management and on asset management side, there are a lot of key ratios. People see it like sharp tenor and all, and it's quite evolved over the decades and all. But what it is more utmost importance I have observed is that if there are governance in place. What does governance mean? Very simple definition. While you'll Google it, you will find a lot of different definition by organizations and the company. That are you following the law of the land in the letter or in the spirit? Now, letter and spirit is something like you get up in the morning and you say yourself and all, and you are able to face it. Yeah, thank God I'm doing right thing, and not going overboard either on my investment or my decision or on my people is extremely important, and also depends on what kind of a stakeholder you are managing it, and it is just purely your investment and risk return, or you are keeping that all the stakeholders in mind while taking the investment decision. And how do you achieve it? You achieve it through framework, you achieve it through policy, you achieve it through conversation route. And some of the risk guys might be there on the call. Primarily they do it, or compliance guy, which I work with. They'll find out the issue and tell, oh, hey, there's a problem. But and just report it. There has to be risk conversation around it. That means there is a collaborative way of dealing the risk issues in place. And how do you do it? Through culture and all, right? So culture, in a sense, your job is to also help the business and grow it and all. So the balance around it, how the risks are decided, who sets the context around it, especially in the corporate world, is primarily it is board who is setting the context around, and management and leadership team being the second line of defense ensure that those are being followed. And how do you follow it? Follow it through framework, policies, monitoring, and accountability around it, those risks and all. The problem is that so far, largely most of the people, especially in the financial services, they have been focusing or concentrating on financial risk. Investment, this much return, this much risk, this much. But nowadays, risks are pretty connected. I mean, gone are the days, and this is what I'm experiencing, because over the period, I have got less hair and more getting white hairs now. That how it is important, what is important is the conduct, the culture, that how you deal with the adversaries. Adversaries will happen, market will go down, market will go up. There will be somebody short, market is going up is a problem. There is somebody's long, market going down is a problem. So there is a risk all the time. But the risk doesn't come as a surprise. It always gives you signal. Always gives you signal. And are you watching those signal? And who is that watching? If it is one person who's a risk guy or compliance guy, then you've got to be lucky that you've got a God. He's not the God. So it is collectively leadership, collective shared responsibility of that group and that business, which ensures that the risks are being discussed, this is being owned, and somebody's monitoring it for sure. But when that is being done, there has to be risk conversation around it. So my point is, the risk has gone beyond financial risk and process risk. It is more now connected, which is now people are talking of the fraud, they're talking of the governance within that. Regulators are becoming very proactive around it, and day by day you would have seen it that they heightened the regulatory scrutiny and the frame, and rightly so, because some of the issues happened in the past and all. See, my take has been that the regulations are not meant for the organizations; they're meant for the investors. It could be India or overseas. That's what I'm observing it. So if client or investors are your primary one, how you're dealing with it, how important your risk frameworks are, how you are measuring it, and are you following the law of the land in letter or spirit? Yeah, because there are many times a gray area and people take advantage of it. So for that is the ethics and conduct. When you do it, how do you do it? And if you do it, your investment for personal, what kind of, and when you do it for the treasury or company and all, how do you do it? Do you apply the same parameter and all? So these are some of the thoughts. I will cover it in the subsequent time. Over to you, Mr. Abhishek.
Abhishek, you're on mute.
Sorry, yeah. Thanks, Mr. Padhe. I think thanks for your input, for giving us such a detailed understanding on what risk is. Clearly, one thing is very clear, risk is here to stay. And as Mr. Padhe correctly stated, that risks can only be either mitigated or minimized. And a good governance structure, a framework where the top to the bottom is involved, there is continuous engagement, conversation around risk parameters. I think these factors do help in ensuring that risks are properly identified, highlighted, and if required, mitigated by alternate mechanisms if there are anything available. So now I'll go on to Mr. Sameer. And Mr. Sameer, if you would like to add on from your experience, what are the sorts of risks normally you would have faced while handling such investment portfolios?
Let me tell you, when we think of risk, I think we let our imagination fly. Okay, basically, I think we have to start at the very inception of a risk in terms of whenever we initiate anything. The way I work is I really let it fly in that sense, because if I have to look at in the framework of the family office concept, I think the biggest risk in anything, because our own the way we are arranged or organized makes a huge difference in the risk parameters itself. So if I have to talk about family, a family is can be, it means if you have to look at it as a family, it can be very touchy, because when we do it professionally, we can get away with a lot of things. But however, when we talk about family, there are a lot of there are niceties and there are a lot of relationships. There are so I would go back to that and say, okay, what are the risks that would have to see from the family itself? I think the first thing that I would want to check is every arrangement, because in the end, if I have to look at myself as a family, I would want to see, okay, is everything is completely in place for my family to do whatever is intended to be done. So I would want, as a compliance person, to get it documented, so that we have a complete governance and understanding. Usually when we do this kind of a thing, if you don't write it, it can lead to a lot of misconceptions or misunderstanding within the family or any arrangement for that matter. So it is important for us to actually look at it, how we are organized, and then set up the entire risk portfolio in terms of what exactly we do. Means I would come to the investment later, but basically putting things in place from the legal perspective would be very important. What exactly we want to make and how long do you want to continue with this particular thing? Do you want this particular office to continue forever, or do you want it for a specific period, etc.? So depending on what is the requirement, I would want to set up things so that it would really deliver whatever it is intended to be done, and then put all the framework in place so that it gives you everybody in that particular framework. I'm saying, if I talk about family, so it could be patriarch or matriarch. So the entire family, the brothers, sisters, nephews, nieces, etc. If I have to talk from that perspective, everybody knows what exactly they're supposed to do and what is the role of each one of them within that particular framework. So thereafter, we come to the investment part of it, what exactly we want to achieve, how we want to do it. And most important part, I think if you see as a risk, I see for me as this thing is inheritance, or how do you want to really, how do you want to go to the next level of it in case there is something that goes wrong or something that mishap happens, how actually has to be distributed. So there has to be a complete framework of both risk has to be looked at, the governance structure has to be built in across it. And we then have to see, once all these things are done, we have to put things in a legalistic manner, which will be conducive to deliver whatever is intended to be done. I think in the nutshell, I would want to say that just to add whatever, because Janmajay had actually covered a lot of it, and adding to whatever he said, I think this is something I would like to add.
Thanks, Samir. I think that was very insightful. Truly, I think unlike corporates, I think families have emotions. Families have different visions. The members of families might have different investment horizon. So I think it is very, very important to document, understand, and perhaps also have a framework around so that there are no misconceptions in terms of how you're investing. Uh, that was very insightful. Thanks, Amir. I would now request if Mr. Sharma, if you have something more to add on in terms of risks which you associate with family offices specifically, or if there are any insights, any incidents which you would want to elaborate so that we have a more clarity on risk associated with family office.
Yeah, thanks, Abhishek. No, I completely agree with what Janmejay and Mr. Samir had said. Family office, the concept of family office has evolved over the last 10 years. The current surge we see in investments in startups and private equities and venture debts principally is we have to thank family offices for that. The HNIs and the ultra HNIs come together, and this is how the startups work actually. So a lot of philosophy goes into the family office management, as Mr. Samir was describing, that the family members come together, have set up a framework, think about it, put their goals, put their expectations, who will do what, all those things are there. And they prepare a document as to what are the expectations, how the assets will be transferred over a period of time, succession, all of that is there in that. So it is a complete organization by itself, the investment organization, as I would put up. And it's a boutique. There are boutique firms and there are large family offices. There are multiple family offices, so on and so forth. But what is important is they take investment as a process-driven activity. So there is an evaluation, there is planning, there is monitoring, there is compliance. There is regulatory aspect, return filings, income tax assessments, complete. There is a complete work activity going on. One important thing what I would like to mention here is, which is typical to family office, that it is more than spreadsheet calculation of investment. It is more than philosophy of investment. It goes beyond that. And what is that beyond? I would call it psychology of investment. So that is more important here, because as soon as investment opportunity comes, so we don't jump into that numbers and figures and returns and what is that. We first try to understand whether does it gel with us, does it gel with our philosophy, whether we derive any comfort or not. So that is what is psychological aspect. So unless we are totally in tune with that investment, we don't proceed. So psychology of investment plays a vital role in doing investments as far as family office is concerned. There could be a equity opportunity from an unlisted company. So before we jump onto the numbers and channel checking and discussions with all that, first we have to put in our mind whether it gels with our philosophy, with our ethos, with our nature, with our culture. There could be negative list, there could be positive list, and all of that. So that is one thing. So identifying the right opportunity by itself is a very important task. Second, very important is when we come across any opportunities, the example of Abhimanyu in Chakravyuh. So we don't want to become Abhimanyu, right? Although he was a great warrior, but we must see the exit first. What is the exit? When is the exit? How we will exit? Whether the desired returns are going to be there while exit or not. So exit is very, very important. Whenever we come across the opportunity, first we see where is the exit and how long it will take. Because one important risk factor is delay, which normally people underestimate it. But the cost of delay can be very high. It can erase the intended returns also. So as they say, delay is default and hence delay is risk. So at the time of investment, at the time of entering into investment, these are some of the important factors we bear in mind. And then we start the number crunching activities, and then the spreadsheet, projections, business plans, the board of the investing companies, and we interact with them, try to understand what is going to be their strategy, where they are going to use the funds, and the corporate governance of those companies, so on and so forth. And then it becomes an elaborate process. So once that we are convinced about it, then internally there is another process of risk measurement, sensitivity analysis. What if something goes wrong to the extent of, let's say, 5% or 10%? What if something fundamentally goes wrong? Then what will happen? How do we retrieve our capital? So on and so forth. Those kind of exercise we carry on. So it's a complete 360-degree evaluation that we do at the time of investment, including compliances, including regulatory, and including governance aspect, which Mr. Upadhyay and which mentioned very briefly. So that's what I want to say.
Thank you, sir. Thanks for that. I think that also opens up the other aspect which we wanted to delve into, which is and I think maybe Sameer can take this up first. Sameer, do you think there are certain operational or organizational risks in terms of the way a family trust functions vis-a-vis way a corporate treasury function would work? Do you see there are certain additional operational challenges, or there are certain organizational challenges which one has to keep in mind from a risk perspective?
If I had to compare, I have don't have a direct relation. I've never dealt with a family office, so I'm just giving what I imagine. Okay, so let me be very honest upfront. But however, whatever I perceive, basically what happens is, if I have to compare this with insurance or banking, okay, in insurance, the investments are really regulated. Means only thing that you really have a play on is maybe 5% of your total AUM. Rest is all it goes into a very focused thing where they say you put it in government so much, you have to put it in these kind of funds so much, AIF has to be so much. Everything is kind of regulated. Everything is kind of provided for, whether it's life insurance or general insurance. It's very regulated. Similarly, in bank also there are so many rules and regulations which actually come in, which sometimes is a good thing, because when the market goes for a toss, the organization is saved of this because of these kind of things which are there. Because if you go overboard, we've known certain banks going completely haywire playing in treasury. I think Bearings was one of them which actually went completely turtle because some player really went overboard, and it led to these things. So India as such is very regulated. But however, when we come to family office kind of thing, I think it is all based on what the family tells you to do. Basically, they set the norms. They said that, okay, what is it? What is my risk appetite? Do I go into this kind of a investment, or do I not go into this kind of? What do I want to do? Do I want to protect my complete structure in terms of how aggressive you are in terms of whether you want to go overboard, or you want to really play by this thing, say that, okay, I'm good to get only X% of interest and I'm happy as long as my principal is completely saved. So this, I think, would go by the entire regulatory framework is not applicable to my mind. Okay, it's subject to correction. Sharma ji can possibly tell me that about it. But as far as whatever I know, I don't think so there is any regulatory when it comes to family offices per se, other than whatever is the other laws of taxation, etc. would matter. But that is more coming out of profits than investments style. So I think that's what it is. It gives you a lot of play, but that is also dangerous, I feel, because if you don't have, you have a complete entire canvas in front of you where you can paint across, and without any those kind of risk appetite, it can be dangerous, and I think it can play both sides.
Thanks, sir. Mr. Sharma, you would like to add on, given your experience of handling family office, do you think that there are certain operational or organizational challenges which are beyond a normal corporate treasury?
Yes, there could be some, especially regulatory. We are talking about regulatory aspects, because basically investments when we make, there are certain assumptions that we make, particularly in respect of taxation or in respect of, let's say, listing or in respect of, let's say, other regulatory aspects. For example, not many years ago, we had this FMP, fixed maturity plan in 2008-9 something, where after 1 year, there could be a long-term capital gains tax. But suddenly, over a period of time, government came and they said that after 3 years, the long-term capital gains would come. And hence, if we had invested in that, then we would not have achieved the long-term capital gain benefit, which we must have evaluated at that time of investment. So certain regulatory aspects which come after we make an investment are definitely a dent in the returns and the investments. Second aspect is, for example, if we are investing in, let's say, bonds, which are subsequently going to be listed. Once we buy, at that point of time, it is not listed. And after the allotment is over, within a period of 30 days or 40 days, they are supposed to get listed. Now, something happens, some non-compliance on the part of the investee company or the issuer, then that investment is not listed. Then the investor is unnecessarily, he has to suffer that. So these kind of regulatory aspects, which are based on certain assumptions, I'm not saying there are many examples that happen like that, but the risk that can happen will really, really jeopardize the investor's interest. And another important part is investment in unlisted companies with a hope that it will be listed over a period of time, let's say 2 years, 3 years, 4 years, and 5 years. But it doesn't happen. Then the exit, the liquidity is at peril. So these are some of the regulatory aspects which do have a formidable bearing on the capital as well as on the returns aspect of the investor. So we have to be mindful about all these things before we evaluate. So we have to understand and we have to prepare our own framework by which we ensure ourselves that there are no regulatory defaults. Some of the track records of those issuer companies can be a good benchmark, or maybe some kind of declaration or some kind of undertaking from them to mitigate such eventualities can be a boon for us. So, but we have to take care of regulatory and we cannot dismiss it off as a non-event. It's very important. Over to you, Abhishek.
Thanks, sir. Thanks. So, Mr. Upadhyay, I would now want your comments on whether you think that from an investment perspective, there are certain challenges or risks which are specifically associated with the family investment office, and if yes, how should as a manager of the family investment office, one should approach it so that he could minimize any negativity around it?
Very important point. So first is, there's a gentleman, iconic person called Benjamin Graham. He has said the successful investing is about managing risk and not avoiding it. A very important one, very simply said it, right? And you would have seen it. Now there are a lot of conversation happening on the family office, trust, framework and all. This was also being done in the past and all, and especially Sharmaji will know a lot. Those Bahi Khata and all, Pizza Munibji will be there and all. That is now getting transitioned into a more professional way. And I know some of the family office, being part of my earlier career, some of the family offices are managed far, far superior or maybe at par with some multinationals or very large institutions. What it means is that they have a documented philosophy around it. They have a documented framework around it. They have a philosophy and ethos around it, that where this money is getting invested and will be invested, what will be the process around it, right? The investment manager decides it. We call it freedom within the boundary. And some of them have done very successful, set a very successful family office, and they have been successful in my studies. And I found it that they're very professional way of managing that organization very dispassionately, unlike they manage their own. So the point is that the governance has been important to them. Investment decisions for that is basically process. And the process is somebody says, I go direct equity, indirect equity, I do ABCD, and if I do it unlisted, I do EFGH thing plus, right? This meeting with my philosophy around it, like for example, some family offices are talking of the ESG investing. That means something around beyond return, right? It's beyond, so something around the society, something around the climate and all. Everybody has own objective around it. Important is that once you document it, it will become clearer to you that where do you want to go it, and how do you evaluate the process, how do you evaluate the decision making around go no go and all, and if there are incident around it, how dispassionately you decide about it. Typically people who are, and this is my experience, more intelligent people, they get into ego because they justify all decision around it. When I decided ABC, there's not extrinsic value around. In that case, the framework helps you that if this BC incident happens, my exit will be there. Not justifying my investment decision that intrinsic value or the rate value of this is not fair and all. Because you got to be God. And very important, in fact, I want to share this here. In my early days of my career, I read a book called Den of Thieves. I want to share with you. Okay? And when I read this Den of Thieves, my faith from governance and all this study went slightly down. Then I read a book written by the great iconic brand name Tata, and it's a book written by Mukund Rajan. If you have a chance, you please do read. It's a great book on the insight on the Tatas and the governance, especially a brand custodian. That all this helps you. In fact, you must also refer it. There's a book written by the guy who's written, what do you call, Jim Collins. Yeah, he has written Good to Great, but the masterpiece of his How Mighty Fall, right? And you will realize it. By and large, everybody knows it how to make. Right? Somebody makes 11%, somebody makes 9.5%. It's not making a difference. But if there's shock happening, if the surprise is happening, how are you dealing with the shock and all? That is only if you have a strong governance. You have a very strong culture. You have a strong ethics. You are not cutting the corners and all. Investments is not only ratios and in due diligence process around investment. Where do you invest it and all? Now regulators are very, like for example, AML. Maybe corporate is applicable, family office thought, but you never know regulators and all, right? There are information security breaches happening. It's not happening only to corporates. If you're a big treasury, you are very much part of it. I'm sure you would have read this Ukraine and Russia news recently. There are a lot of attacks happening around it. How you are protecting your data information around it? We're not talking of 10,000, 50,000, 1 lakh, our kind of your kind of investment. It's a million of investment being done, right? So there are other risks need to be watchful on, and it has to be a shared responsibility. However, somebody has to be accountable. All this will happen, culture, conduct, governance, and documented, because that helps you like a North Pole. Right? So Dhruv Tare ki tarah, that this is what all of us made it. This is our investment objective, and this wall will stick to it. Now, this needs to be visited. It cannot be the investment manager decision. It can't be fund manager decision on it. Right? Collectively, you revisit it. And some of the large setup in India, the big iconic HDFC and all, if you get a chance to read Tamal Bandyopadhyay's book, Back One, it says there has been issues in all organizations. How do you deal with this? Tata Finance issue happened. How Tata's handle it? It's all because of strong governance, all because all ethics and all issues will happen. How do you deal when the situation arises? It's very important and all. Investment decisions are process. Yeah.
Thanks, Mr. Padre. That was very insightful. I think very true, rightly said that investment decisions are made at a point in time. They can go right or wrong. What is important is that if your principles are laid down well, you would be in a position to always find when to exit, and whether if an investment has gone outside your risk horizon, how to exit. So I think those are important parameters which one has to keep in mind.
And also there are a lot of new opportunity coming and all. And there's a herd mentality. Somebody says blockchain, somebody say crypto, somebody. Do you understand it, right? If you understand, only then you give the neck, unless you want to allocate some part of your capital and say this is my punt. Right. And it is also part of the strategy that 5% of my fund can be for experience or learning around it. But it has to be documented. Otherwise, you never know. This 5% becomes 10%, 10 becomes 30%. One day you're wiped out.
True.
Yeah. So, and that's only possible when your investment objective, which Mr. Sharma very beautifully said it in, is if investment objectives are defined, your investment thesis, your investment philosophy documented, and you are sticking to it. If there are deviation, you are also open to revisit it and do it. And the word itself is called family office, right? That means a family is managed. Just English word, I'm not expert on it. And then has been a lot of case studies around it, the big giants, big corporates and all. They had split and got it all over all because family issues. So how you are addressing it, how you are documenting it, right? And I can't name those, at least everybody will know it, and some of us will know it, which are the top corporates and all, where the issue on the family feud happened and then organization it impacted at large. Some of them have been able to succeed and manage it because of A, B, C, D reason. And Tata's or maybe Birlas are one of the great examples of this. Just for academic interest, somebody wants to study it. However, there are other than Tata's and Birlas who have been able to manage their family office business at par or better than some of these names because of ABCD regions. And those ABCD regions are governance, conduct, philosophy, investment objective, and all this. Thank you very much.
Thank you, sir. So then we will now move on to another important risk parameter. Again, I would request Mr. Sharma to come in here and if he has some views on around it. Do you think that cyber risk, fraud risks are as relevant to family offices, or are these risks because they are largely private owned, smaller size, maybe not now? Most of these are quite big now. But are these risks relevant for a family investment office? And if yes, what precautions should the treasury manager keep in terms of mitigating these risks?
So cyber risk, as of now, I'm not seeing it as a major threat for a family office, basically. It could be a major threat for the fund houses or for treasury operations organizations or insurance companies or banking. But for a family office investment, cyber frauds are, as of now, not a major threat or not a major risk. For us, the major risk is compliance. When I say compliance, what I mean is wherever we are investing, so based on certain pitch material or based on the information memorandum, based on the PPM as we call it, we have made the investment. Now, whether the fund managers are really complying with what they had stated in their original document, whether they are planning and whether they are investing according to that strictly or not, is a major risk for us. Because if they are in a pitch deck, they might say something else and actually the investment happens in a different way, then it's a major risk for us. And I would call that as a fraud, because you are telling something else and you are doing something else. So it is very important for us at the investment level to ensure that what is the criteria, what are the stipulations of investment that the fund manager is promising to you, and whether he is capable of doing it or not. Does his past track record tells something about that or not, is what we have to ultimately do in our evaluation. As Mr. Upadhyay just mentioned about the family office internal structure and how they should work. So typically we have something called investment philosophy statement, wherein everything is laid down as to what exactly is to be done, how it is to be done, when it is to be done. All those things are specified. So we have to strictly, and that is the holy grail for us. So we try to model all our investments as per that parameters. And then there is something called asset allocation. So based on the IPS, we emerges the asset allocation. Now, all the investments opportunities that come, we have to benchmark it with such IPS and then see how it reflects in the asset allocation. So this is what we call is fitment. See, all investments have to fit into your frame, and then only you can go for the investment. And then there is a procedure of approvals and putting it to the IC and then benchmarking it with peers, industry, all those things happen. So one risk factor is you take a deviation from your IPS or allocation when you come across a very important or a very, very lucrative opportunity. Even though your IPS doesn't permit, you tend to take a deviation and then invest. It's very important for us in such a case to really monitor it very closely, because if something goes wrong, not only that investment and the returns fail, but your overall asset allocation also gets disturbed. And in the long run, all the returns get disturbed. So it is very important that we monitor such things. Another important thing is the deviation part should always be, time horizon should be fixed. It cannot be an endless deviation, because endless deviation means you are changing the IPS. The intention is not to change the IPS, just to allow a deviation for a certain time gap. So that is important, to take a deviation. Second important thing is the rebalancing act that we normally do. Whenever there is any change in the asset allocation, then some resources out of debt goes into equity and some from equity into debt. So that rebalancing discipline has to be there. So overall, family office investments, or for that matter, any investment, is basically has to be a disciplined exercise. It cannot be emotional, or it cannot be, just for the sake of doing it. It has to be a disciplined one. The moment you lose that discipline, I'm sure there is going to be a big task for you. So compliance wise, you have to monitor whether the intended investment, the investment thesis that was propounded at the time of investment, whether it is catering to that or not. The moment you come across that, no, there is a deviation by the fund manager or the investing company, then you have to really, take him to the task and say that this is not done, because you cannot have something which you had not planned or you have not said. So that's not done. So we at the family office have to continuously, quarterly updates, and we have to do a lot of reading into that, understand the fine print, understand the numbers, what are the returns, and so on and so forth. So for us, compliance is a basic risk for us, whether what was told to us, what was intended is actually being done or not. In the guise of higher returns, the fund manager tends to take certain risks at some point of time. So there we have to be mindful and do put some questions as to why this was done and how it was done. Then the problem comes of defaults in the investee companies. So how that default is reported is also one of the risk factor for us as an investor. You have to really understand what is that default, because as I said earlier, delay is also a default, and delay is always camouflage, saying that it was restructured, we have given him more time, this and that. So your red flag should always be raised at that point of time. The moment there is a delay, automatically the red flag has to be triggered. Otherwise, there is a problem. So this is what exactly we do. So as long as the returns are coming timely, that's one thing. The delay is there, we probe it. What is the delay? What is the genuinity? Whether it was really required to restructure or there are some other intentions, so on and so forth. So for us, compliance as well as reporting assumes paramount importance. So if the reporting is not done at a regular interval, there is a risk. So we take it as a risk and we try to be more proactive in getting the information. So that's what I mean. Over to you, Abhishek.
Thanks, Atan sir. I think that almost, I believe, summarizes most of the risk, which at least I wanted to get a clarity upon. My takeaway from your discussions have been that just like a company, whenever you're incorporating maybe a family office, the first thing you need to do is to ensure that the charter document is proper and adequately covers the aspirations of the family trust. So just like there's an article of association or a memorandum of association for a company, the charter document has to clearly outline what is the investment profile of the family trust, what are the expectations, what are the risks which they are willing to take, and what are the boundaries within which they would want to play. Anything which is outside has to be then again taken and filtered back right from the family itself rather than at a lower level, because then it would not be correct fitment. Second, I think, which we have, Mr. Sharma has just outlined, is that once the the strategic matrix is put in, the operational matrix comes into picture, which is ensuring that everything that is being done within that framework. Not only is it being done, but the reporting structure is so robust that it is being reported timely, correctly, and adequately, so that there is no gap in terms of whatever has been laid down in the charter and whatever the manager or the investment manager is undertaking on behalf of the family. Yep. And so I think if there are any other things which any one of you would like to speak upon or highlight, which probably we have not covered in the discussion, I would now leave it open for you to probably speak out on those points.
Okay, just to add to whatever means, it is really insightful for me to listen to Sharma ji as well as Janmjay. Only one point I would like to add is as a lawyer, I would always say that we should have a repository of documents, which means you could have a lot of these documentation, but if the documentation is not in place or it is faulty, that could be really a difficult aspect, especially if you're doing it in real estate, because I'm sure in the family office, so there will be a lot of investment coming in real estate, etc. Also, it would also be in terms of if you're investing into a startup, your agreement has to be very, very tight, and you should have, as Sharma ji said, that there has to be an exit door which has to be very clearly articulated, and the consequences that you want to really build in to what is to meet your requirement. Okay, if it is the thing that in 5 years it has to fructify into some kind of a listing, etc., or whatever it may be, but it has to be very clearly articulated, and the exit route has to be very clearly said, so that there are no heartburns at the end of it, and there is always a exit route available for the investor. So, and plus, without really reinforcing that, these days and times, income tax and so many other departments come calling. So if you have a repository of all your documents, it would be a great, it will be a solace when things really fall apart, or if there is anything that has to be done. And plus, in terms of, as a banker, I can say this with this thing, you should definitely have nominations, etc., because you have to think about in case of certain events which are not really happy events, but it does happen. It's that's something which is very, very real, that if somebody passes away, etc. So you have to have that kind of a thing, that the investment that ever you made is secure, and it really doesn't have to go through a long loop of law. So that's one thing I would like to add, Abhishek.
Abhishek, what I would like to add here is, just to summarize partly what I had said. One is the compliance part. So we have to be sure of where we are investing and for what purpose we are investing. Second part, I mentioned about the exits that we should be aware of. Third part, I said about the reporting, that we should be continuously monitoring the reports. And just as Mr. Samir said, in the documentation part, the various clauses and all those things are absolutely important. And if we are a sizable investor, then the question of board representation is also very important. And another attendant important point here is the right to and access to information, because this is where the entire problem resides. If we have lack of information, lack of communication is the root of the problems. So that is one important thing. And another message, which I would say it is a message to all the investors, is never ever take the pre-tax return as your benchmark. It should always be post-tax, because what is post-tax is an inevitable thing. So after tax, if your returns are very, very low compared to, or maybe just few notch above the risk-free return or the non-taxable return, then that whether the risk that you are taking is commensurate with the post-tax return. Generally, what we have seen is people talk about pre-tax return. even the opportunities that come to you, even the fund managers, then when they speak to you, they always speak about pre-tax return. And that is where we think that the investor really is taken for a ride. Always insist for a post-tax return. Calculate yourself and see whether post-tax return are compared with the risk that you are taking, whether it is commensurate or not. That is should be the real gauge of returns. Abhishek.
Thank you, sir. Thanks a ton. Sharon, unfortunately, since I had to join through the mobile, I'm not being able to see the questions if there are any from the participants. So would request if you could help us on that.
Yes, sure. I do not see any questions yet. I'll just check on for the chat box as well. No, right now I don't see any questions, Abhishek.
Yep. So I think that's all from our end. If there are any questions, even if participants want to put in later, you can then probably route it to any one of us.
Sure. So I urge the participants, if you have any questions, we still have around 15 minutes more with us. We are ahead of schedule, so feel free to post in your questions within the chat box, the Q&A tab, uh, and a panelist would be happy to take up the questions.
Till the time the questions come, can I get it?
Sure.
Yes.
Yeah. So I think we had a very good interactive this thing. I think one thing for sure is coming out is that you defined freedom within the boundaries. That means document it what you want to do it. But all this also creates bureaucracy, right? And bureaucracy, that means unlimited leeway not there. But it helps it. There is something called good bureaucracy. There is something called bad bureaucracy, right? And you will study more. Some of the organizations we started like a family office or proprietary firm, which are there for 100 years, 90 years. Why they have been successful? I joined Faculty Templeton 3 months back, and 1 month I was going through so many training programs on this policy, that policy, and all. When I look back in hindsight, say why this organization is successful for 80 years, how they're surviving it. It's primarily because of their protocols are set, and that is what it helps you to grow and manage the complexity around it. As long as you are 1-2 member team, as long as you're milling some millions, which most of the cases, most of the large setup started it, right? But when you grow up, and you will grow up, you will, if you start the foundation on some of these things we spoke, I think it will go a long way. And when you look back, you will say that we were in the right step. But if you have not documented all you had in brain, and it was known to only some of you or one of you, is something to be ponderable, is a scalable model for investment and growing the wealth and ensuring the risk management around it. That's all from my side. Thank you very much.
Yes, Sharon.
Thank you, Mr. Janmajay. Yeah. Thank you, Abhishek. I think I don't see any questions as such coming across. Maybe if we receive, we'll be happy to email it across to you, and certainly you can help us with the answers. Thank you so much, Abhishek, for moderating. Thank you, Janmajay, so much for that insightful session. Mr. Samir, Mr. Balkrishnan, it's been a pleasure having each one of you with us. With this, I thank you for the whole session and close of this particular panel. Thank you so much
Thank
once
you
again,
so
all
much.
of you.
Thank you, Sharon, for
Thanks.
organizing it beautifully. Thank you.
Thank
Thank you
you
so
so
much.
much, Mr. Balkrishnan. Thank you.
Bye.
Okay, great. So since we all are ahead of the schedule, we would start with the next session at 4. That is on the start of family office investment, a very exciting and a very interesting topic. Put in your more questions if you have in mind. There's something if you're expecting out for the next panel, you can share your expectations from the panel. Meanwhile, our panelists join in. Thank you. We start off with the session at sharp 4.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Good afternoon, everybody. Welcome back. So, as I mentioned, that we have a very exciting panel discussion. That's the last panel of the day. That's on startup family office investment. Please join me in welcoming our moderator, Mr. Pankaj Chopra, investor and partner, India Accelerator. He's a serial angel investor, speaker, mentor, panelist, and a founder, deeply committed towards adding value to the startup ecosystem and revolutionizing the entrepreneurship picture in India. He's invested in over 80 plus startups and also including Galaxy Cards, Lloyd, Natures, Tatwa, VAPP, Tech Eagle, and also a partner and investor with India Accelerator. A very warm welcome to you, Pankaj. Accompanying him on the
Thank you,
panel.
Sharon.
Thank you. Accompanying him on the panel, our next member is Mr. Satyabrata Das, who's the angel investor and finance expert. He's an experienced chief financial officer with over 20 years of experience in building and leading high performance finance commercial teams. He's skilled in partnering finance with the co-operations and developing productive cross-enterprise alliances. He's also a member of ACC UK, CPA, Australia, and Kenya. Welcome, Satya. Also we have Mr. Prashant Pansare, who's the founder and the CEO of Intellement Group and Rubiscape Private Limited. He's an innovator at heart and an entrepreneur by profession. He's founded Rubiscape in 2020, India's first unified data science product company. As an investor, advisor, and mentor, he's also helped several startups and researchers. A very warm welcome to you, Prashant. Last but not the least, we have Mr. Kedar Sabne, who's an entrepreneur, startup advisor, and a financial consultant. He's played a key role in settling up in the international businesses for various companies and has more than 20 countries. He's a rank holder, chartered accountant, a qualified company secretary. He's also worked as a financial controller at IBIT, and he also has worked with Tech Mahindra and MCO. A very warm welcome to all of you. Looking forward to an exciting discussion, Pankaj and panelists. Over to you, Pankaj.
Thank you so much, Sharon. Good evening, and thank you for giving me this opportunity to moderating this panel discussion. Thank you, Satya, Kedar, and Prashant for taking our time and coming in. So, as we already know, Kedar has a very decorated career in terms of managing startup family funds. So Kedar, to start with you, I have, as you've been very active in managing the family offices funds to be invested in startups, I would start from you by asking you a question, which is, what are the advantages you see to raise funds from family offices versus a VC fund?
Yeah, at the outset, thank you, Franklin, for this opportunity. Thank you, Pankaj, for this introduction and quick start of this session. Yeah, I think the question is very, very pertinent and valid since I manage family money. I think today, if I have to just tell you some statistics, almost in 2021, 47% of the investments that have happened in startups are, directly gone into startups versus, people are investing 32% through VC funds and PEs, whereas 11% are going through kind of debt funds. So net, what is happening is if you see the statistics, most of the players who are family promoted family offices, they are basically driving the majority of investments into the startups directly on their from their own family offices, and that actually helps. So there are pros and cons, and one or couple of things which I would like to say when you ask me a question about advantage. I think the family office, first of all, is a successful office which has created a corpus which is out of their own hard work, and that corpus is well earned to be deployed for other startup or budding entrepreneurs. So I think that is the first advantage, that they understand that how a starter should be nurtured. So if you ask me if we don't need a lot of funds to start with to make a mark, I think I would definitely advise the startups to look out for family promoted funds, first of all.
So great, moving on from a subject matter expert who has, handholded a couple of family offices, I would want to move on to Prashant, who's a successful founder and has done a lot of international business consulting, mentoring a lot of startups also. So Prashant, to you now, I would want to ask you, as a startup founder, what are the advantages you see to raise funds from family offices or a VC fund? As you have reached at a stage of raising funds, your views as a founder will be quite valuable at this point. Prashant, you're on mute.
Sorry for that. Thanks, Pankaj. Since afternoon, there have been quite thought-provoking deliberations happening. And I think it is also very right timing, with the context where we are seeing the startups are, actually mushrooming in India, and probably all-time high in last probably few years, the number of startups that are getting registered and funded and how they're being leapfrogging. Also, we are seeing that last 1 year, the maximum number of unicorns are coming, out of the startup ecosystem from India. And we are quite progressively maturing on this curve. Now, coming to your point, which is very valid, when we are looking at the startup ecosystem, which is now getting fast and furious in India, there had been now more options and avenues opening up. And when we look at the angels and the VCs on one side, the family offices are emerging as one of the popular choices, and it has obvious reasons, as Kedar also mentioned some of them. One definitely is that the kind of startups that are actually coming in are no longer only the nascent stage startups, or they are predominantly extremely seasoned professionals getting into a very serious tech or digital business, or there are companies that are getting into the startup mode, enterprises or their divisions or new strategic initiatives that are getting into the startup mode, where the innovation and disruption can happen fast and furious. And when you look at this kind of probably a maturity and a hunger, looking at the market potential, you also need that kind of an investment support or a mechanism, an ecosystem that can help you in amplifying this effect. So just borrowing from where Kedar left it, is that the family offices have their own reasons beyond only the financial muscle power. But if you look at some of the strategic advantages that these kind of the startup investment can bring to them, makes it balancing on both sides. So whether it is high growth potential startup on one side, looking at the fund traction, as well as the strategic investment or an entry, or also beyond the funding, they're looking at the management bandwidth or an outreach to certain specific segment, whether it is discovering a new market segment, or getting into the strategic avenue, which could also be of an interest to the family office, like diversification, for example. Or if the family office is also looking at the tech innovation, to get into the high growth potential, or it could also be creating succession or next generation kind of an involvement, or it can also be an impact investing. So when we look at these kind of avenues, they make it kind of a better match on both sides, with respect to how and why the family offices are emerging as a very effective alternative, or rather a preferred option for the startups that are led by the seasoned talent.
Great, Prashant. Thank you so much for your views. Sorry, Kedar, would you want to add something
Yeah,
here?
I just wanted to add to what Prashant said, with three factors that actually help if I have to promote family office as a culture to invest in startups. First is they can be fast, because from a VC and the due diligence and a lot of processes are lengthy processes. So what is extremely important is that if somebody really wants a fund, and the idea is sold, and there is a team which can really execute the idea, and the promoter has a previous background of this particular business, the decisions are faster and they can get access to the money quickly. So there is one point. Second, and unlike a VC, there is no call down and so on and so forth. So, things move pretty quickly. Second is the flexibility. So when it comes to promoter-led investments or family office investments, there is definitely a flexibility with respect to the exits. Unlike a VC, what happens is there is a pressure of timelines that you perform in 3 years, 4 years, 5 years. Give me a
So let's take a pause for a couple of seconds, or else we'll move on to Satya. Kedar, if you're audible, you've got a bandwidth issue at your end.
Seems like that.
No problem. So what we'll do is quickly, of course, what Kedar was saying, and what Prashant also said, from an SME to a founder. Now I would want to, quickly jump on to an investor. Satya has aggressively invested in a lot of startups, and from diverse industries, from a deep tech to a legal tech to an insure tech. So, Satya, a quick question to you here. What are the various ways in which a family offices in the different stages and learning curve invest in startups today? If you could throw some light on them.
Right. So thanks, Pankaj. Thanks, Franklin Templeton, for the opportunity, and thanks, Prashant, as well. See, to answer your question, I think investors go through a learning curve. I think it's true for all sorts of investors, if I want to put it that way, right? And of course, learn, rectify, learn, improve, learn, perfect. I think that's how it works. And everyone, I mean, when you get into a certain sort of investing, whether it's angel investing, whether it's equity investing, or any sort of investing, you tend to start with certain errors or mistakes, and it's good to learn. So same what I'm going to speak here. I mean, I will break it into 3 types, and this is more practical approach than a theoretical or a bookish approach, right? So the first type of, I mean, we hear so much about startup investing right now in newspapers everywhere. We are just like, also very good programs are coming on TV, like the Shark Tank, etc. So people are, of course, all that, everyone wants to be in that space. But from a perspective, doesn't necessarily mean that, at every stage, whether it's a family office or an investor takes a very structured decision in terms of investing,
right? But everyone wants to talk about it because right now it is the in thing where you want to be. So I would like to break this into three. So there is the first kind, which is a very nascent early stage, whether it's a family office, whether it's an investor, it's the FOMO investing, where basically you are feeling like you've missed out on a lot, your other peers are taking on everything. So at this point, what you tend to do is you want to do cover as many deals, whether there is a strategic approach or you have a goal or an objective or not, you want to do as many deals as you want to, right? And then of course you learn from it, and sometimes you realize that this is not the best way after a certain period. Then comes the second possible stage, which is basically what I would call a social comfort investing. That okay, a friend of mine or another people we know very comfortable with has basically done my part of the work, which is to do the due diligence. I believe in him. But one of the biggest assumptions is sometimes you negate all the aspects of evaluating, and you tend to do it just because your friend has recommended that particular thing. And effectively, you also don't know whether they have experts or not. I think most family offices or investors would do good to do their own research, which everyone says, whether it's a cryptocurrency or angel investor, do your own research, right? Then obviously the third one is a more matured stage where you have an institutionalized approach. I think Kedar spoke about it. It's templatized. You have to tick all the check boxes. There is no way anything can happen. You become a little rigid, and when you become big, you have to become rigid, because otherwise there are lots of gaps and flows can happen if you don't. So I think so basically this kind of structure brings in an issue in terms of rigidity at a later point in time, but brings in a lot of advantages in terms of actual investment in startups. Over to you, Pankaj.
Very rightly said. In fact, on a very lighter side, we saw Shark Tank, which we believe, because we are in the startup ecosystem, which we believe that a startup can get funded in not less than 2 minutes. So that is now not how it goes, guys. So thank you so much for enlightening the audience around the first question, which I threw over to you guys. Quickly moving on, Kedar, as a subject matter expert, I would want you to take this question. Apart from the due diligence and valuation, do you think that the family offices should be checking any other aspects before they actually make up their mind to make that investment?
Yeah, Pankaj, certainly. Sorry, I think there is some bandwidth issue. Therefore, I am just keeping my video off so that we can hear and talk to each other. Sorry about that. Yes, again, when it comes to the private market investments, today investment in startups is almost comprising of 18% of the overall pie, which also means a lot of people have recognized startup as one of the best avenues to invest, and they are aware that it is a risky affair, but at the end of the day, that is also they can get a kicker with respect to if one of their 10th unicorn investment becomes a unicorn. I think they made it all. So apart from the valuation game, because I believe at times the valuation is, according to me now, a person who cuts a check, writes the number is the value, because Excel sheets and extrapolations everybody can do for 5 years, DCF, whatever valuation mechanism you want to use, it is all paper, unless people have started moving from the valuation to first happy customer. So that is the very, very important milestone that every startup should achieve. That do you have a multi-year contract? Do you have a customer who says I'm happy with you, and do you see that he is able to give you the sustainable business? So that could be one. Apart from that, there are other hygiene checks which are part of the shareholders agreement that one must definitely look at. One could be the founder's background. Only one founder with the great pedigree of IITs, IIM doesn't really help, because if there are 3 or 4 founders together shaping a process, they all need to be tied up. They basically add value to the overall proposition. So how is the team composition? So I have come across a lot of startups where they have great pictures on their PPTs, and when you ask them are these guys in your office? They say, no, one is in UK, one is in Europe, one is in Canada. So what happens is that all good figures come there on the PPT, but when it comes to everybody's a part-timer. So if the skin is not in the game, then, how do we make it successful? So these are the checkpoints that one must definitely look at. That are you paying them full-time salary? Are they working for you, dedicatedly? Their residence status is also very, very important, because see, if you are investing in India and somebody says, I'm going to do, unless he is doing a business development outside India, I buy that point. Otherwise, we have to meet them quite frequently. If everybody is operating in a remote world, especially, the COVID has been an exception, but apart from that, I think we should meet them on a quarterly basis, on a monthly basis, so that we know how they are doing and what are their thought processes. And a couple of more, typically the exit term should be very, very clear. If one of the founder decides, or a major stakeholder decides to leave because of some lucrative, better opportunity, because every startup has a gestation period. And if somebody is not ready to, wait for that particular period of 2-3 years to make sure that the startup becomes successful, then the shareholders agreement should have a clear carve out provisions that, okay, if you want to step out, these are 1 to 3 things that you have to give back to me, or so on and so forth, so that we are in control of that startup. Otherwise, if he sells to somebody else and the interest is not there, then it completely becomes a chaos to handle legal issues, then the business model kind of issues. And last one, which I would like to say, that a lot of people have started introducing performance-linked investments. You do achieve a milestone, and then we give you a tranche. So maybe there is a commitment, and once the commitment is given, the overall figure is definitely there. But on a quarterly basis, on a 6-monthly basis, you definitely need to add value, prove it, and take the check for the next tranche. And there is also a vice versa mechanism. If you are underperforming and you had committed a lot of things, I think on a yearly basis, you can start, diluting the stakes of the key players who were just there for the sake of it. And if you are not able to perform, then the investor may have a clause in the shareholders agreement that if you underperform, certain portion of the money, certain portion of the equity can come back to the investor, so that you take charge of that particular startup and make sure that you get a right investor, giving that equity to him, and raise the money company to basically prosper. So I think these are a few pointers which I just wanted to draw attention to, because these are not the documented one. They generally come out of the experience, and especially the bad experience. So I just thought of sharing, since it is a forum where promoters are there, family offices are there, and they may just get a few 2 cents from my side while they are investing in startups. Thanks, Pankaj.
Absolutely, Kedar. I can relate to the same. A lot of Excels, the valuation gig which has been happening, and of course, but I strongly feel that we are now getting into a reality phase where rather than validation, the product fitment and the product scalability is what the investor is looking at. So I here would want Prashant to come in and tell his view on, as he's a startup founder, have you faced any such situation while raising funds?
Yeah, in fact, Kedar made some really very valid points, and maybe a couple of more things that I can add to it is that if you actually look at the trend of investments by the family offices, they are actually picking up the tech side, the digital and tech side startups more popularly, because first is there's a huge, massive market up there. Innovative and disruptive models are springing up. More importantly, it has the hyper scalability factor. Now, just to add, some more pointers is that how do you define your customer and a paying customer and consumers, and what are the number of consumers when you're talking about it in the scale phase, and then the consumers and the active consumers, because at times that also becomes sometimes a trap with respect to the active subscriptions or active customers, and that leads to sometimes confusion, or also what were probably the parameters with which the valuation or a market sizing was done. Now, when we broadly speak that, when we are looking at this kind of attraction from family businesses, the exploration and qualification on both sides certainly help. That if you understand that what are the goal, objectives, strategies for the family, office, as well as the startup, when they're actually seeking the investment, are you going to randomly anybody, or you are really looking at it could be a strategic fit, which will increase your maybe qualification, or midterm to short-term better fitment proposition. And if you look at what is happening is, thanks to COVID and lockdown situations, that has brought in the digital agenda or automation and the high-tech stuff as reality. So if you look at, there are so many sectors which are doing extremely well and recession proof, but they have a huge potential for the tech startups. And that makes it very logical to many of the family offices. If I have to give you examples, look at healthcare. And I strongly believe after maybe retail, telecom, and fintech, the next big tech disruption is going to happen in the health tech segment. And if you look at the trend, the kind of artificial intelligence or blockchain kind of technology adoption that is happening in creating highly innovative, disruptive health tech models, or food tech for that matter. We are seeing that food tech is also exploding, and with countries like India, which are highly populated countries, getting the millions of customers on fold every now and then. So when we are looking at tech-backed, these startups, these models are now getting settled and mature, right? Probably a few years back, if you would think, even Uber or Airbnb model were like kind of, are they hypothetical models? But they're here to stay. And what has happened is, if you look at EdTech for that matter, right, it has actually completely changed the way the industry was operating with the new policies coming in globally. Even in India, when we are adopting that, it is creating a very substantial basis and opening up the market segment where these digital and tech startup business models, we often call them as OTT business models, asset light business models for a shared economy that leverage on crowdsourcing. And these new terms are now getting much more familiar with the investors and the startups, and how they're being able to create the real value which can be substantial, right? For instance, look at what is happening in automotive industry with the electric vehicle, right? When your power generation itself for the vehicle is changing completely, there are a lot of family office investments from that sector happening in emerging and new age tech startup. If you look at healthcare, maybe image processing as a service, if you take that as an area, that has a huge potential for low cost innovations in country like India, where you're doing radiology as a service, or maybe using artificial intelligence, you are actually helping the surgeons and oncologists detect where the cancer is happening, so that the medical consultations can actually go more and more digital and virtual, which ultimately benefits the end customer. It brings in hyper scalability, accuracy, authenticity in the overall service model. And these are the businesses, these are the segments which actually becomes much more interesting proposition for the family offices who are already operating in those segments. So that helps them in strategic entries into the market segments or the customer segments which otherwise they would have not reached out, right? And if you see what is also happening in last probably 18 months during the lockdown, is that we are seeing the decentralization of the extreme urbanization that was happening. So if you look at how we popularly say India and Bharat, right, the urban and rural, so that divide is getting bridged. And very interesting statistics recently published by Google in India is that the mobile users have surpassed English speaking population over the regional languages. What it means is that in India, now you have non-English speaking population of users is more than the English speaking population of the users, means regionalization and localization. So when you're looking at these kind of last mile innovations that can tap into the consumers or users where they are, that is what is really becoming an interest to the family offices or established businesses. At the same time, they understand that if they have to do it, it becomes a very monolithic system to respond very fast and furious to the market potential. And instead of losing out on that early mover advantage, that's where they also want to pick up the startups who are agile, who are nimble, who can actually move very fast in the market to create a value. On other side, if you see in country like us, now thanks to the Shark Tank initiatives, which are also bringing in this in limelight. Because if you think a few years back, getting into the startup was not perceived as something that would really be a viable option. But if you look at the statistics in last 3 years, things are actually moving very fast and furious. So hence I said that when we are looking at the family office and the startups on both sides, there are a lot of logical connections. You just have to make connect the dots more logically, and I think there is a good potential and a fit there.
Absolutely, Prashant. Pandemic has actually created a lot of opportunity in the crisis. We can see the logistics ecosystem multifold booming in a very big way. And in fact, if we buy somehow the founders can crack the code, I'm sure we will have the maximum number of unicorns coming out of our India startup ecosystem.
Absolutely.
Coming directly, yes, absolutely. Coming directly to our investor here. So Satya, what do you think about the family offices can do to manage the risk in startup investments? Any quick tips here?
Okay, I guess this is a very learned audience, and I won't be able to say something which is completely unique because I guess they're all finance experts, and I will say basically something which they all know. I'll try and say it in a more practical approach. Obviously, my typical would be in 3 steps. One is there should be a sector focus. That means there should be a try to diversify. I mean, we've heard that diversification is important in any portfolio. So there should be a diversification so that there are so many. I mean, I don't need to repeat health tech, AI, augmented reality, virtual reality. I mean, e-vehicles. There are so many new spaces that are coming, and it is better that that you diversify your portfolio. I think that's very, very important. I mean, there is a possibility initially that a family or an investor does not have a sector specific understanding, but that's where the experts come into the picture. But I think diversification is extremely important. The second thing is, should they invest via funds or should they invest directly? Because that's another risk factor. I think for a startup, starting investments, I mean, whether it's a family office, effectively they should, because it just hedges them for a bit to be investing through funds, because the due diligence bit, the technical analysis bit, etc., is already done. They have a better space. And of course, over a period of time, once the comfort zone is reached, obviously they can invest, they should invest directly as well. And as and when the corpus increases, of course, they will be directly reached out as well. Right. Then finally, there should be a mix of the stage focus. There is early stage, there is obviously pre-growth stage, then there is obviously growth stage, and all of these have a very different ticket sizes as far as investments is concerned. So the family office should know what is their thing, and there should be a mix between the 3 so that there is a proper hedge, because we know that the early stage is risky, but then it can give you massive returns as well. And again, there may be more stability in a growth stage investment, but then the ticket size is huge and you may not be getting that multiple folds, right? So I think these are my takings in terms of how they can manage some sort of a risk. Obviously, there are many more things they can do from a bookish perspective in terms of how analysis is done about before they go into an investment. But I do feel that a family office will play an extremely key role in the development of India's entrepreneurial talent, and that definitely adds a massive responsibility also, that that to make sure that the role brings in benefit to the family office and also to the startup ecosystem per se, because an unplanned approach or a very risky approach may create a group of disgruntled sort of investor set. Over to you, Pankaj. Thank you.
Thank you so much for that insight, Satya. Of course, an unplanned decision can erode a lot of capital. Of course, that is one thing which we have to take care of. Which comes to my final question for this panel, and of course goes directly to the expert on the family offices investments, is Kedar. Kedar, as you have been actively, closing startup investments for family offices, what's your view on, is there a way out to exit from a failed startup for the investors? Any insight on this?
Yeah, I think, it is extremely important that if, the family offices know a way out, I think the culture of startup should not be eroded. This is where we have just started coming and coming a long way, unlike a Silicon Valley. So whenever I'm going to talk, I always promote a startup culture. But all said and done, they are startups. They are likely to fail, and instead of getting demotivated, can we do it in a better way, where the same money can be adjusted, same money can be utilized, in a better way from a tax planning aspect also. So I just wanted to draw your attention to a couple of sections in income tax, which takes care of the 112A, and read with section 70 to 74, which talks about the long-term, short-term, read with the set of clauses. The purpose is that if you have invested in unlisted shares, and there is a long-term capital loss, I mean, you have to stay put for a couple of years to qualify yourself as a long-term loss. And if that loss is there, you can always adjust it against your long-term gains, because see, generally these are surplus amounts carved out for startup investments. So the family office definitely has a lot of long-term gains from their other investments that they are doing. So if we plan it properly, there could be a benefit where the only thing is that you have to find a party to sell, book that particular loss. So, you have to create a transaction. Once the transaction is created, you can very well absorb the loss in your books, and actually it neutralizes. So that investment doesn't become a dead investment. You can actually take some tax benefit out of that. One more thing which can also be looked at, that instead of investing a big ticket in one go, especially where the startups are at their nascent phase, I would also recommend if we could have a mix, like instead of committing 5 million in one go, can we commit 5 million as a number, but 1 million as a direct capital investment, and 4 million in tranches as a short-term loan? Two reasons. If the startup starts doing well, you can always increase the tranche. You can keep the loan on the books if it is fine. And if you have to withdraw some certain gains, once the startup starts making profit, it could be, I think it is an alternative to a dividend if you look at it. So because it is, as far as the books are concerned, it is treated as a loan. When you withdraw from the loan, it is not taxable. But the company has made profit, and there is a, the money comes out. So this is again a theoretical discussion, but a practical solution where your investment can be treated as a loan from directors. Of course, you have to take a director position or shareholders position to allow the company to take the money in. And then, you can look at it as a petty dividend that can come back to you, but that gives you a confidence that my investment has not gone haywire, and I have every penny to collect back if things go well. So I think a couple of things can help, and I definitely want to motivate promoters and family offices to invest in startup, because that culture, that energy, that enthusiasm, and the kind of crazy stuff people are doing in the startup world, let's not hamper them. Let's promote them, because this money is out of their surplus money, and I I keep on meeting a lot of promoters, and they feel that they have done it hard way. They had no risk capital to support them. If today I have a risk capital, let me give it to a budding entrepreneur who will make success out of it. I mean, I think promoters are okay for failures because they know the startup is a risky business. So I would certainly still recommend that please continue investing in startups, because they are creating jobs, they are increasing our GDP, and we plan to see more unicorns coming out of India as well. So over to you, Pankaj.
Thank you so much for that insight, Kedar. That was quite helpful. Anything else, Satya or Prashant, you would want to add here?
Oh yes, absolutely. Just to take the baton forward where Kedar left it, and let me bring in a little more optimistic view, because India has always been the IT services superpower. How it can become IP superpower, with more products and startups coming out from India. And there is also a reason. In fact, for the startup products, one of the major growth potential and the market available is also domestic market, right? So unlike any other IT company would always look at the Western market. Now, if you let me share with you some interesting statistics. If you look at data consumption in India has actually grown 7x in last 2 years, and that's phenomenal, right? So when the world was locked down, the digitization and data consumption has been all-time high. All of us know India has been the mobile internet economy, which is the lowest in the world, right? If you just take into account the digital payments that have happened in the lockdown are close to about 44 billion transactions being recorded by the NPI and your various digital ways and means of payments. And what does this indicate? If you actually see 830 million internet users. Now, how can this be leveraged where people are not only looking at this for a connection or communication and entertainment, but how more and more new business models can come in? And one point which I would like to mention, because Kedar also brought in this, the socio-economic impact and how it can also contribute to the nation building cause. At times, people think that extreme high-tech, digital powered business models, will they take away jobs? Some conventional repetitive jobs they may reduce, but they will create tremendous amount of employment in a country like us. And it same thing happened when a computer era was coming in India during the 80s. Of course it does take away few government and public sector jobs, but it created a huge big industry. So when we talk about the artificial intelligence kind of technologies, we already have a policy around it, and I'll not be surprised if India get a AI ministry very soon, and how it can actually not only create the digital experience to a customer experience, but how it can create a huge powerful ecosystem within India that can spring many more startup and viable business models. And I think that is also one of the reason why family offices should be very keenly, proactively looking at this segment, for investment.
Very rightly enlightened that, Prashant. As now we have a big government ecosystem which is governing the startup, we will definitely have something regarding the artificial intelligence. I'm very sure while we're talking, somebody somewhere is making a policy around it. Satya, anything here you would like to add?
Yeah, I mean, in line of what I have been speaking, I think the importance is that while an investment is made in startups, I think the importance is they're encouraged, and that a partnership, it's like a proper marriage, and it helps the startup flourish. I think that's extremely important. I mean, we are obviously seeing what's happening with BharatPay, etc. I mean, I don't want to repeat that. Everyone's reading that, but effectively, these are, you have to learn from things that have happened so that you're not reinventing the wheel. It's important to be collaborative. It's important to be happy. It's important to be to be encouraging, because again, we are talking about completely building an entrepreneurship ecosystem here, which has to go massive, which is obviously massive, and it'll grow more massive. And that's about it from my side, Pankaj. Thank you.
Absolutely, absolutely. So with this, I would say a big thanks to Satya, Prashant, and Kedar for sharing your insights today on the Startup Family Office investments topic. And of course, to Franklin Templeton for organizing such a grand event and giving us an opportunity to share some insights around the same. Thank you so much.
Thank you.
Thank you.
Thank you so much, Pankaj. I think it's been a very insightful session. With this, we come to the end of the day one of Family Office Summit and Awards. I know it's been a very interactive day with a lot of insights from a lot of leaders from different parts of the industries coming with different expertise, experience, and it's always wonderful to see, all of you sharing your own journeys with everybody. So I think I'm sure there's been a lot of learning out here. So thank you once again, Pankaj and the panelists, Satya, Mr. Prashant, Mr. Kedar, for joining us for this conference. And I look forward to all the attendees again tomorrow for the day 2 panel sessions, interactive discussions, and yes, the award ceremony as well. So thank you so much once again.
Thank you
Thanks
so
for
much.
joining.
Thank you so much, Sharon. Thank you, guys. Have a great day
Thank
ahead.
you.
Stay safe.
Okay.
Thank you so much. Bye-bye.
Bye-bye.
Thank you so much. Please note that for the link for tomorrow's conference is the same. You can certainly register. Even the leaders, if you plan to join in, would be great to have you all once again. You can join and attend the other sessions for tomorrow as well. So yes, the link remains the same. Certainly the same procedure as you did for today. Joining the link, getting registered, getting the joining link, and entering the meeting. So yes,
Thank you. Thank you so
that's
much.
all.
Thank you. Thank you so
Thank
much.
you so much, everybody. Have a good evening. Thank you.
Bye-bye.
Bye-bye.